12 months. The scores this morning, and good morning to you, look like this. On the S&P 500, pulling back yesterday, pulling back again this morning by 1/3 of 1%. Yields up yesterday, up again today by 4 basis points, 397. First trading day of the year, dollar stronger. Day two, at least a dollar stronger again. The euro, 109.22.
Yeah, it's really a continuation of what we saw yesterday. Today, Fed speak does resume. I know that everyone is very pleased to hear that. 8:30 a.m., Richmond Fed President Tom Barkin begins his day-long discussion with a number of different events. This one with Raleigh Chamber of Commerce. Does he lean into some of the market softness, saying, yeah, people got over their skis when it came to how much they were pricing in our rate cuts? 10 a.m. again, ISM manufacturing, JOLTS job openings, the sort of predecessor, the drumbeat to Friday's jobs report. What I am curious about, we've seen more than a year of sub-50 ISM manufacturing rates. That is contractionary territory. Do we see a continuation of this? And does it matter, considering that the disinflation that we're seeing from goods has not played out in services in the same kind of way? To me, honestly, I keep thinking about that, John. Honestly, this to me has been one of the biggest mysteries, because you shouldn't follow the manufacturing numbers if you want to understand where the economy is going.
So, big question. Did they talk about cuts in the minutes based on what you've just said?
We may get an answer at 2 p.m. today. We do get the FOMC meeting minutes.
A few.
Many? Some? A couple?
No, I don't.
Interest rate cuts?
I don't think we're going to get an answer. But I do think that we're going to get a reaction from markets that will be interesting to understand where people are positioned right now. Do they press the sell button if there is not explicit pushback or explicit discussion of rate cuts in those meeting minutes?
At 2 p.m. Eastern time, that's where the price action might be, a little bit later on this afternoon.
Why are you laughing at me?
Because you won't be awake. Tracy McMillan, head of Global Asset Allocation Strategy at Wells Fargo Investment Institute, will be awake at 2 p.m. Eastern time. Tracy, wonderful to catch up with you, and Happy New Year. I want to start with a line of yours. Recent data generally feeds the soft landing thesis. We remain skeptical. Tracy, why are you skeptical?
Well, we're skeptical mainly because the Fed has signaled 3 rate cuts in 2024, but the markets have taken that to mean 6 rate cuts in 2024. So there's got to be a reconciliation that will happen. Markets are saying that inflation just keeps falling and the economy holds up. And we're skeptical of that. We think that either inflation falls because the economy continues to weaken, or the economy stays strong and the Fed is not able to cut 6 times. So as we go through that reconciliation process, we think that that's probably going to pressure rates a bit higher, and it's going to pressure equity markets a bit lower.
Tracy, your note is absolutely brilliant on the call that earnings will not be the double-digit earnings that a lot of the street is looking at. Down the income statement, where will it be evident that earnings will be short? Is it at revenue? Is it at gross margin? Or is it deeper down?
Yeah, it's probably going to be both of those. It's probably going to be on the revenue side because consumers may start to pull back. We had tremendous spending over the holiday season, but we think that that might be the last hurrah for especially the consumers lower down in the inflation quintiles. We're starting to see a lot of stress there, and as they look to expand spending, they may be looking to borrowing. Borrowing costs are now much higher, and so that's going to limit spending in those lower quartiles. And our research has shown that the upper quintile cannot make up the difference for the bottom 4. So we think consumer starts to weaken here, and so that will pressure revenues. We think margins are also going to be weaker here because of expenses related to continuing wage pressure. So we think that that's going to be a big part of it as well.
I'm struggling to understand the rationale for different people as they get a little more bearish in the rally that we saw for 9 straight weeks. It seems like Max Kettner is talking about strength in the economy causing rates to be higher. You're saying that rates are going to be higher, but that we're going to have weakness, the economic weakness that a lot of people were expecting. Is that stagflation? Is that sort of inconsistent, given that a lot of people think that weakness will bring down inflation and will bring down rates further?
Yeah, so maybe one thing that's being missed here is that lower rates really started to take hold when the Treasury went to a shorter duration issuance. And when they pivot back to longer term paper, that could pressure rates higher too. So, and as rates move higher, we do think that that's going to pressure risk assets. So we do think that the economy can continue its weakening trajectory, even though rates might start to move a bit higher.
What are we going to do with the use of cash? I mean, given the Wells Fargo caution that I see here, the fact is there's going to be free cash flow. What's going to be different this year?
Yeah, so what we're going to see in terms of investor cash spending and the free cash flow that companies have is that more money is going to be flowing into cash assets. It's probably going to be flowing into equities as well, but we might wait to see a bit of a pullback in the equity markets before we start to see that cash flowing back in.
This goes right to what we were talking about before you came on, Tracy, a bit of a pullback. Aren't corrections good? Because they bring up the fear you need for you to go higher?
Corrections are good, and I think that one thing that investors often miss is that corrections tend to happen every year. We typically do see a 10% pullback at some point throughout the year, and that does give investors the opportunity to rebalance their portfolios. So if an investor's invested in a diversified portfolio with stocks and bonds, short-term fixed income is one place we like right now because that's kind of a holding place. If we get that pullback, we can move assets from fixed income, short-term fixed income, back into risk assets. And we do see markets by the end of the year.
Let's just finish up there, Tracy, this question around whether we're going to see a rotation, that rotation trade out of big tech into the rest of the index. Are you actually bearish on big tech as you expect to see that kind of rotation?
So we're not bearish, no. We are neutral right now on information technology. We were actually favorable for a good part of last year, pulled back on that trade, took some gains, and we've moved it more to cyclical sectors like industrials and materials. We also like healthcare here for the defensive nature of that sector.
Tracy, appreciate the update. Thanks for being with us and Happy New Year again. Tracy McMillan there of Wells Fargo Investment Institute. TK skeptical of the soft landing thesis. The data's been moving in that direction and the market has for sure.
A lot of different opinions out there. I mean, everybody's recalibrating now. I love what Robin Wigglesworth did over at the FT. I love what Sam Potter did at Bloomberg, just collated, 600 some outlooks. Everybody, do you have an outlook, Jen?
A personal outlook.
The Bramo outlook was 42 pages.
No agenda.
It was, there's an outlook. I mean, everybody's got an outlook.
The outlook is, I have no clue. I mean, honestly, I don't even have a sense of if we get certain economic data, what the market response is going to be.
I think that's correct.
Will it be good news for equities? Will it be bad news for equities, given the fact that rates could go up? What Tracy just said there about Treasury issuance, to me, caught my attention because I knew that it would not catch anyone else's attention, but I thought that was really interesting. The Treasury has been issuing more short-term debt, not long-term debt. If they go back to issuing long-term debt, you could see yields go up even with the weakness she's talking about.
Hey, look, I love what you said just a moment ago, Lisa, because we say a lot on this program. You need to get two bets right, and sometimes it's really difficult. The bet on the economy and then the bet on the market off the back of it. I would say this also, the bet on interest rates, even those who forecast where the Fed would ultimately end up, they got the call on the economy dead wrong. How many people saw the Fed going to both 5.5% and then the economy delivering GDP growth of something like 5% in the third quarter?
Zero, nobody. And this has really been the big surprise from last year. The big surprise for this year is, do we get the long and variable lags, or did the lags already happen? And we're just going to move on and we can chug along with this kind of benchmark.
And still don't know with any conviction whatsoever. If you are just joining us, welcome to the program. Of course, the price action this morning, pulling back just a touch. We're negative 0.36%. Yields are a little bit higher by 4 basis points, 397. It is truly turning 2023 upside down, Lisa, to start 2024.
And can it stick? I mean, I understand the lunacy of us trying to come up with a narrative for the entirety of 2024 with 2 trading days of 2023. Not even.
Sober January, apparently.
We have two trading days in 2024, and all of a sudden we've summed up January and the rest of the year. That said, it does tell you where people were positioned and sort of this feeling of euphoria that people are gut checking right now. I think that that is a sort of telling moment given where the bias had been for the previous 9 weeks.
Just quickly, a couple of programming notes for you. JP Morgan's Phil Camporelli is going to join us in the next hour, so in about 50 minutes from now. And just confirm this one, Tom, conversation you do not want to miss. Norman Rule, former senior U.S. intelligence official on the latest out of the Middle East.
Without question, our conversation of the day on our fractured international relations, and of course you go to the border between Israel and Lebanon.
The prospect of escalation, Tom, is still the question,
Huge,
isn't it?
Huge, yeah. And not only, that's a really important insight, not only escalation, John, but a more multiple depth at the same time escalation. We're not used to that. I mean, that's different.
That story just around the corner. Here's the story right now. Equity futures near session lows. We're negative 0.4% on the S&P 500. Treasuries lower, yields are higher by 4 basis points. The dollar a touch stronger. From New York City this morning, good morning.
In London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything. The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was
The
expecting.
bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
The president has said we are ready to act in self-defense if needed. I'm certainly not going to get into specifics of our military operations, but the president is always and has always been committed to our service member and protecting our service member abroad, and that's what the president's going to be committed to.
That was White House Press Secretary Karine Jean-Pierre speaking on ABC yesterday as the Biden administration looks to defend against Houthi attacks in the Red Sea. The potential for a new battlefront has always been the risk over the last several months. The risk of that taking place, Tom, may be escalating just a touch based on recent news, and we can assess that risk in just a moment. The latest this morning, according to Hamas, a senior Hamas leader killed by Israel in an explosion, Tom, in Beirut.
And the distance here is important. It's not all that great a distance from Gaza to Lebanon, but I think within the Eastern Mediterranean, John, it shows the multiple fronts here and all of a sudden there's a whole new immediacy that wasn't there 2 weeks ago.
Trying to take the temperature of this, Tom, in the commodity market is really difficult. October, crude lower. November, December, crude lower. This morning, WTI doing nothing, $70.30. Brent crude positive by just 0.1% to $75.99.
Let's get to it, and we do it with an authority that we have had throughout the torment of the Eastern Mediterranean. Norman Rule joins us now, Senior Advisor at the Center for Strategic and International Studies, and of course his work for the nation in intelligence. Norman, when I say Lebanon, for all of us of a certain persuasion, we are completely formed by something, frankly, a stunning 40 years ago, which is the Beirut barracks bombing when we lost Marines at accountable Iwo Jima level. Where are we now with Lebanon, with Hezbollah? Do we have a relationship, or was it forever fractured 40 years ago?
That's an excellent point, and I regret I remember that incident well and lost friends. The event of 40 years ago actually had a different message for the world. The U.S. pulled out of Lebanon at that time. And Osama bin Laden later stated that watching the withdrawal of the United States from Lebanon was one of the motivators for him to undertake his operations, because he realized the West could be pushed back out of the region.
Are we being pushed back now? I mean, within the multiple fronts that Lisa Abramowitz has outlined this morning, Gaza, the West Bank, and again up to the border with Lebanon, is America being pushed out now?
No, we have a very different profile, and indeed diplomacy is likely going to increase in intensity in coming weeks, because we need to come up with a way to move Lebanese Hezbollah north of the Israeli border so that Israeli citizens can return to their homes, the thousands, tens of thousands of Israeli citizens to open their businesses, go to school, and also so that tens of thousands of Lebanese can return south to that border, which has become such a flashpoint in recent weeks.
Yeah, hundreds of thousands of people have been misplaced or displaced as a result of some of the fighting on both sides. But Norman, I'm curious whether this is an escalation. The fact that Israel did attack, according to Hamas, but also with a wink, wink, nod, nod from Israeli officials, to kill this Hamas executive.
Well, to be clear, Israel has stated from the beginning of the October 7th massacre that it would eradicate the Hamas leadership responsible for that action. And therefore, this is no surprise. I think what you have to look at is this drone attack, which Israel has not admitted but is understood to have undertaken, took place in an incredibly security-conscious neighborhood. And it demonstrates an exquisite and dynamic intelligence capacity. So as Hezbollah thinks about its response to this, it's got to think about what is known around us and what can we get away with, and what will happen to the people who might be involved in that attack against Israel.
Do you have any sense, Norman, of what the conversations are like with Hamas, with Hezbollah, with the Iranian leadership, given the fact that a lot of people think that they're taking some cues from Iran, that there has been funding from Iran, that you have the Iranian warship going to the Red Sea, and the Houthis, also Iranian-backed, making noise and trying to interrupt Western shipping lines?
Iran and its proxies have no strategic drivers to involve themselves more fully in this conflict. It would impact multiple strategic equities for a gain that is uncertain, but they have multiple incentives to continue and perhaps raise the intensity of attacks against Israel to show that they have skin in the resistance game. I should also note that today, the January 3rd, is the 4th anniversary of the killing of Qasem Soleimani, and that's a day when one would expect Iranian proxies to attack U.S. or Israeli forces just for that symbolic anniversary.
Exactly where I wanted to go. Norman, let's talk about it. The assassination of the Major General. It's easy to forget that it ever happened, because several weeks later, many weeks later, we were all drowning in a global pandemic. What has happened since then with the relationship between the United States and Iran, between two different White Houses?
Very little. The indirect engagement that took place did produce the possibility of of some sort of engagement, a hostage release by the Iranians in exchange for the release of personnel. But Iran's regional activities did not change. And I don't think the White House expected them to change. More so, Iran's nuclear program has continued to expand. And here's the important point. Iran is now producing enriched uranium at a level that no state that has not pursued a nuclear weapon has ever produced. It has no civilian use for the nature of its current enrichment. So you have to ask yourself the question, has the West de facto recognized an Iranian military nuclear program? The White House would say no, but the facts do raise the question.
Norman, a tough way to segue here, but I'm going to do it as one final question. Taiwan continues to come up within our first of the year conversations. Do we have good intelligence on mainland China?
The United States intelligence program against China, has stated by Central Intelligence Agency head Bill Burns, is robust and works significantly. I won't comment on those operations to the extent that I know of them, but I will say that this remains such a priority that it's an all-source intelligence program, so with all imagery and a variety of different aspects, we're going to have a good understanding of some of China's activities that will provide the warning policymakers need.
Norman, thank you, sir, for the update. Your insight, so valuable. Norman Rule there for the Centre for Strategic and International Studies. Thank you, sir, and a Happy New Year. Cut off for Happy New Year. Official. January 5th.
Official, come
official.
on. According to
it's
who?
official.
The FARA rules of existence?
Just they've been established for a long, long time.
Something like that.
Page 24, Pharaoh's Manners book.
Just because of that, I'm going to say Happy New Year till February 29th. And there is
February
a February 29th. Yeah.
Oh, there is.
Yeah.
It's one of those years.
Yeah.
There's a 29th this year, huh?
Yeah.
Thanks for that.
News you need to know.
That's news you can use. Thank you for that.
Okay.
The cut-off is the 5th, all right?
Yeah,
It's a hard
March
cut-off.
5th.
No more of that. I can't believe it's been 4 years, Tom, since the assassination of Qasem Soleimani. I just remember sitting there that evening in New York City watching this play out on the news, on cable news here in America, facing a real prospect of maybe some kind of military escalation between two nations. That was basically the big story to start the year. And then all of a sudden we're drowning in a pandemic and it's not talked about through much of 2020.
And to my book of the year, The Loom of Time, from Robert Kaplan, he really emphasizes this, John. We underplay Iran. I'm guilty of this like everyone else.
I'll just point out that Iranian state TV is reporting that there were some explosions near the grave of the Iranian commander Soleimani today, in this anniversary day. We don't know more details about it, but still, that tension very much forefront of people's minds. And it raises this question to Norman Rule. The fact that the U.S. hasn't gone more aggressively against Iran raises this question of whether they're tacitly accepting the nuclear program they've been continuing, or is it basically just there's this ginger dance to try to avoid some massive conflagration that nobody wants?
Well, that's the ginger dance is what we've been doing.
What's the ginger dance?
You know.
You want to get up and do it?
What is that? What is that?
I'm gonna
That's
just
what
stop.
that is?
Yeah. Let's just move on.
All right.
Like, come on,
It's a real education this morning. Thank you.
Can I point out something off of what
You know
Ramos
where I was
said?
at.
Do you know that here at Bloomberg, February 29th is a work day?
News you also need to know.
Are you suggesting it should be a national holiday?
I think there's, it should be. I mean, they're squeezing another day out of us. I mean, that's.
I think the election should be a national holiday. I really do believe that. I still don't understand.
Any other holidays?
I don't understand why it's not.
Well,
That's so
many
odd to
nations
me.
do it on Sunday, but yeah, you're right. If you're going to do it on Tuesday,
It should be.
give everybody,
It's an easy one.
yeah, it's an easy
You
one.
know, so you should
Okay.
be able to do is also say Happy New Year for an extended period of time.
I mean, look, it's a free world. Just saying, if I had
Just not
preferred
here.
speech, I'm saying if I had preferred speech on campus,
On
my preferred
campus.
speech would be,
That would be that.
ends January 5th, all
Okay,
right?
safe space.
Get back to school.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We're like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Following 9 weeks of gains on the S&P 500, the equity market meets gravity. Yesterday on the S&P lower, this morning lower by 0.4% on the S&P. On the Nasdaq 100 down by 0.6. The Russell of small caps down almost a full percentage point. On the Nasdaq yesterday, the worst day since October. Sounds dreadful, Lisa, following a 54% rally through 2023.
Meeting gravity, I love that. I just imagine someone on the monkey bars like myself and meeting gravity. There's a question though here, when we look forward, can you create a narrative from this? Is this sort of the rotation that people were looking for, or is this something more dramatic where people perhaps got a little ahead of themselves at the end of last year? Hard to really make a narrative, but it gives you a sense of just how crowded some of the positioning was, particularly in tech.
Well, big winners towards the end of last year, discretionary tech, to your point, were the big losers yesterday. Big winners in yesterday's session, healthcare, utilities. Banks stood out to me. Yields up, banks did okay. Thank you, JP Morgan, once again.
And it also was Citigroup with Mike Mayo coming out and talking about a tripling in the stocks. At what point are we talking about what's good for JP Morgan is good for JP Morgan? We mentioned this earlier versus what's good for all the banks. There is a feeling that something has to give. Private equity companies are going to have some exits on their funds. They're going to have IPOs. You've got companies that have to refinance debt. Banks are going to cash in on all of that at a time when you do see enough stability for them to maybe get some of that action.
Bank earnings from JP Morgan 2 Fridays away, so next week that's a story for us. Elsewhere in the bond market, Lisa, yields up yesterday, yields up again today of 5 basis points, having a little look at 4% on a 10-year, 3.98 with Fed minutes coming up a little bit later.
Do they or don't they discuss the potential for rate cuts next year, this year? I guess I'm going to have to remind myself that we're already in 2024 about 15 times. Happy New Year. Just want to mention
Happy
that.
New Year to you.
Yeah,
also, should we point out, while we were away on our different sojourns,
January 3rd, it's okay.
Not only Happy New Year, but birthday greetings to Jonathan Farrow.
Thank you, TK.
It slipped in there. So what is it like to have a birthday
on New Year's
so
Eve?
near New Year's Eve? What was
it's
it
on
like
New
as
Year's
a kid?
Eve, Tom.
Was it traumatic? Did you think they were
this
throwing...
sort of like heartfelt, emotional birthday wish in December? That's what you got from me?
Yeah, you know.
Bramo texted me. Everyone messaged me, apart from...
I wasn't aware. My people didn't tell me it was your birthday. But what was it like as a kid? Did you think they were having a party for you
I
at
took it
midnight?
personally when they celebrated when my birthday finished. Which is what often happens, right? It's fireworks and yay and champagne corks flying. And now I go to bed really early, just very on brand.
This is the reason why you have an issue with Happy New Year. Let's discuss more.
Well, we can. It's
Dr. Lisa.
Childhood grammar.
Childhood drama.
Tortured.
Okay.
That's our first under surveillance today, right?
Let's get to foreign exchange. Thank you for the birthday wishes. Let's get to FX and finish on the euro. 109.27. We talked a lot about how 2024 so far, early days of course, is 2023 upside down, and at least the dollar's no different.
Yeah, well, what we saw yesterday was the biggest rally at the dollar, stronger versus the euro since March. I mean, just the sense of how much we were set up for this, because everyone was talking about the weakness in the euro region, that they still wouldn't cut rates as soon as the Federal Reserve. Somehow people bought into that over the last couple of weeks.
It's kind of odd. If there's going to be a central bank that cuts rates, Tom, based on deterioration in economic activity, Isn't the ECB seeing it already?
Yeah,
Never mind
ECB's
the Fed and the US economy.
Within the
ECB's
ballet
gotta
that
be
we
out
do,
front.
ECB's got to be way out front on this. And to sum off that, I would look at Swiss franc as sort of a triangulation of what's going on.
Which has been super, super strong.
Yeah, super.
That's the FX market. A dollar a touch stronger this morning. Under surveillance today, a senior Hamas leader killed in an explosion in Lebanon's capital of Beirut. The Palestinian militant group saying Israel was behind the strike, raising fresh concerns of a wider conflict in the Red Sea. Mass stopping its ships once again from sailing through the area. Lisa, the whole coming after another of its carriers came under attack in the span of just a few weeks.
And if you're curious how the market's responding and you take a look at crude, it's down, it's not. So at this point, even as we worry about escalation and we take a look at the potential ramifications, markets are not waking up to them. And I keep pointing to this in my head and saying, does this mean that the risk is off the table, or does this mean that markets have gotten used to ignoring any kind of geopolitics?
The warm embrace of 13.3 million barrels a day of oil production in America, no doubt, is shaping this to some extent. Shaping this market a little bit later, tons of data. We need to talk about the ISM manufacturing and jolts. That's going to come at 10 a.m. Eastern time, so a few hours from now. Later on this afternoon, 2 p.m. Eastern time, Fed minutes from the December meeting, a meeting in which Chairman Powell said in the news conference that officials discussed rate cuts. Since then, we've had a range of officials saying different things about that little dovish till. Anna Wong of Bloomberg Economics expecting the minutes to strike a delicate balance. Lisa, between the two camps.
Or a ginger dance, if you wish. I honestly am curious, though, about how the market responds to this, because ultimately it's going to be the data, and we can dance around this all we want, but it's not really going to drive things 3 days from now. That's my sense.
Tom, 2 p.m. Eastern time. Big deal.
No, I don't think it's a big deal. I think it's going to be a lot of speeches. They're massively ex-post, and I'm going to go to where wage growth is in ECI. The ECI Wages and Benefits Index is nowhere near where they have permission to cut rates. Nowhere near.
Let's go local. Let's talk about house prices. Manhattan home prices rising for the first time in more than a year. Purchases in the fourth quarter up 5.1% from a year earlier, the first annual increase since the third quarter of 2022. Now, you might be thinking this is about interest rates, going to the bank, borrowing lots of money at 6% or whatever. No, more than 2/3 of Manhattan buyers paid cash, the highest share since Miller Samuel started tracking in 2014. 2/3 paying cash.
And the median price of these purchases, $1.16 million. This isn't exactly people who are on the lower income sphere who are saying, yes, interest rates have fallen all the way back down to 6.5%.
It's a good message in that we tend to aggregate things, and particularly I aggregate things around 3 zip codes, and the answer is there's a lot of nuances nationally to what we see, which is supposed to be rent disinflation, and we'll have to see on that. Right now we're going to get to it, and this is without question our yield, our rate, maybe folded into the Fed discussion of the day. Gennady Goldberg joins us, head of U.S. rate strategy at TD Securities. I'm going to cut to the chase. You say at some point we're going to get to a lower rate regime, 3%. How far behind is the Federal Open Market Committee? I know they got to wait for wage inflation to come in and that, but how far behind is Jerome Powell right now?
I mean, that's the big question. You know, it's interesting. They've sent a very dovish signal. And as Lisa mentioned earlier, I mean, there's been a lot of pushback on, you know, that dovishness from other Fed officials. They don't know. What scared them, I think, is inflation actually coming down a lot faster than they initially anticipated. I mean, they were looking at inflation basically coming, you know, 50 basis points lower between their Q3 and Q4 summary of economic projections. That's a heck of a miss. You know, you were talking 50 basis points just in one quarter. That makes real rates a lot higher in real terms right now than they initially expected. That's tightening financial conditions pretty significantly.
I feel like some Fed officials have been trolling us, making out that we didn't hear what we did hear in the news conference. So I always pull up the quote from Chairman Powell just to remind myself that I actually did hear it. When he said the question of when it will become appropriate to begin dialing back the amount of policy restraint in place is clearly a topic of discussion now in the world, and also a discussion for us at our meeting today. Would you expect to see something like that in the minutes at 2 p.m. Eastern time?
I think there's going to be a lot for everybody. You know, I think there's going to be some hawkishness, some dovishness. I think you're going to see the discussion come through. What you're not going to see come through is an exact, you know, commitment to cutting rates in March. And what's interesting to me is that the market right now is almost perfectly priced in for a March cut. That's not what you're going to see in the minutes. The minutes are going to be all sorts of discussion about what it would take, what it would get the Fed comfortable. You know, as we were talking about wages earlier, wages aren't quite there, but inflation is coming lower. So yes, the data is important, But the inflation data next week, I would say, is probably even more important than the Fed minutes, than payrolls, anything this week.
To that point, the reaction function seems to have changed at the Fed. And that, to me, was even bigger than what Fed Chair Powell was saying with the potential discussion around Fed rate cuts. It seems like the Fed is more amenable to the idea of cutting rates just simply in response to inflation going lower than anything else, and especially in protection of the labor market. Do you see that as being reflected, that suddenly it really is not about a long-term kind of feeling that they need to kill off once and for all this inflation beast?
I think they're getting more comfortable with inflation actually being a little bit more under control. They're very reluctant to break out that mission accomplished banner just yet. They know how that goes historically, but they're getting a little bit more comfortable. And now what they're saying is, we've got the data basically in a good spot. You know, labor markets are still chugging along, growth is still chugging along. We can start bringing down rates earlier. We don't want to over tighten. I think that's the message they're sending. That's why they've tipped their hand that they are net dovish, but the markets are probably overreacting a little bit.
Well, are they though? I mean, if you take a look, for example, at housing prices, rents are coming down, and that's what we see in some of the inputs to CPI. But as we were just talking about, home prices are climbing. That's going to feed in later. There are these other kind of areas that are inflationary pressures that are going to come down the pike that aren't going to be reflected in the data that we get over the next couple of months. How much is the Fed going to really miss the boat here in terms of being able to kill off inflation? And we're going to see that later this year.
Well, what's interesting is, even if you take, you know, our, let's say, more aggressive profile into account, so we've got 200 basis points of rate cuts penciled in for this year, another 50 for next year. So going back to 3% on the funds rate, even if you take that into account with our inflation projections, the real Fed funds rate, ex ante, is still going to be about 6.5 to 6.75. Excuse me, 1.5 to 1.75%. A little too high there. But you know, we are looking for still a real Fed funds rate that is notably positive to anything we've seen over the last 15 years. It's still going to be tightening, just not quite at the pace the Fed was tightening at. We're at about 3.5% right now and declining.
Let me get an honest question from you, because Toronto Dominion has great Toronto Maple Leaf seats, and maybe you can talk on this, where a lot of our guests can't talk on this. They're constrained. To your good point about elevated real rates and the tension in private equity and private credit now, I just did a 3-month LIBOR, to go back, folks, to 1985. Almost 40-year regression of the great disinflation is seen in 3-month LIBOR, that benchmark, the keel of the sailboat, if you will. Right now, we are out 3 standard deviations, higher yields. It's anomalous in every sense of the way back 40 years. What is the urgency now of the Fed to normalize rates to assist a financial system that may be breaking?
Well, I think they're worried about over-tight. And that's what they're telling you. That's what Powell kind of came out and basically tipped his hand to. The rest of the FOMC, I don't know how much on board they are with, you know, really delivering that soft of a landing. And that's the big tension here, is how aggressively does the Fed pursue the soft landing? How comfortable are they that they've actually declared mission accomplished on inflation? And how comfortable are they that you know, that easing is going to actually feed through into the data fast enough to deliver that soft landing? Because markets are perfectly priced right now for soft landing.
Did you get the feeling that that was Chairman Powell on an aircraft carrier with the banner behind him saying, mission accomplished?
While also somehow, you know, ignoring that and making belief that that banner wasn't actually behind him.
Right, that's kind of what it felt like.
Right, and that's what you got from the other Fed speakers, including John Williams, you know, who came out basically, you know, a couple of days later and said, no, there was no banner there, right? There wasn't a mission accomplished banner. So they're trying to have it both ways, which is why I think late in the cycle, you want to be very careful about, you know, listening to the Fed. Think about what they have to do, right? They're telling you they want to deliver that very soft landing, which means they do want to be a little bit more aggressive on cuts, not aggressive enough to actually start them tomorrow or the day after. But if inflation keeps coming down, and that's what they were telling you, if inflation keeps falling, they will deliver those cuts, probably starting relatively soon.
Hasn't the market already cut rates for them?
Effectively. So they've sort of over-eased financial conditions, and I think that's the big risk right now, is that have they actually thrown another round of financial conditions easing into the mix where they don't need to deliver the cuts. They don't need to go in March as the market's pricing in. They can go in May or June and very easily keep financial conditions accommodative.
We've got payrolls on Friday, and I'm looking at some of the estimates. 190 from Goldman Sachs. Citi just published 190 over at Citi. What are you and the team looking for on Friday?
We're looking at 180, so right about there. There's a lot of uncertainty around December payrolls. Just keep that in mind. Lots of seasonal factors. The important thing is that employment rate at 3.8%. You know, if that stays steady, that tells us we're not really deteriorating that sharply. If we continue to drift higher as we have, you know, we've gone from a low of 3.4 to 3.8. It's been a very silent drift higher. If that continues, that tells us there's more labor market slack. A lot of it's from the supply side, but we'll see what happens on the demand side as well. We haven't seen the layoffs yet.
Gennady Goldberg. Gennady, thank you, sir. Appreciate it. Appreciate it. Looking ahead to payrolls Friday. The estimate, the consensus estimate, the median in our survey, which is often a moving target because we get new estimates as the week progresses, that's about 170. 190, Tom. The estimate is Citi, 190 at Goldman. We just heard from Gennady that they're looking for about 180.
Yeah, nowhere near what David Kelly at JP Morgan's modeling out, which is negative non-farm payrolls out there somewhere, and it's out there. Where are we out to? 2025 on that? I don't know.
No idea.
I'm still getting used to 24.
JP Morgan, record high. Up next, Gerard Cassidy of RBC Capital Markets from New York. This is Bloomberg.
What do you worry most about your economy in Greece? And when you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that, you know, in 5 years from now, we will not have sacrificed, you know, the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
I think the bottom line is that Citigroup is becoming a much more simple and profitable firm whose earnings should double over the next 3 years. But this is make or break time for Jane Fraser. You said, is this due to Jane Fraser? Maybe. I think so.
Yeah.
But not definitely.
That was Mike Mayo of Wells Fargo naming Citi his top pick for 2024, saying he expects shares to more than double over the next 3 years. This is JP Morgan. Hits a fresh record high for the first time in more than 2 years. Gerard Cassidy, large cap bank analyst at RBC Capital Markets, writing this. After a tumultuous 2023, we believe the banks are well positioned for investors to earn outsized returns in 2024, and investors should overweight the sector in their portfolios. Gerard Cassidy, I'm pleased to say, joins us now. Gerard, let's go straight to it. Number one question. This is a question for me, and I know it's a question for Lisa. Is this off the back of higher yields or lower yields?
I would say, John, that we're expecting that the yields gravitate lower, especially at the front end of the curve. When you take a look at what the Fed has done, if we truly are at the terminal rate for Fed funds, in the past 4 tightening cycles, when they started to cut rates, it's always been a catalyst for bank stocks. And I think what we're expecting, as the market is, that at some point in 24, the Fed could cut short-term interest rates.
Is this for bank stocks or is this for JP Morgan?
Lisa, very good question, because JP Morgan has been the risk-off trade, and it's been spectacular, as you guys mentioned, record highs. And so if we're going into a risk-on environment, which I believe we are if the Fed is finished tightening, then actually JP Morgan's probably going to be a source of funds for many investors. It is a stock that is owned everywhere. It's been a great stock. But risk on may be the better way to go with a Bank of America or Citigroup or others like that.
A source of funds. I love that. It's a euphemism for it gets sold so that you can raise money to buy something you think is going to return more. The fact that you think it's going to be Bank of America, do you also lean into the Mike Mayo idea that Citigroup and its whole revamp with some of its streamlining, cutting units, massive job cuts is going to be the real winner?
Over time, it's going to be certainly an opportunity to be a winner. They've still got a lot of heavy lifting. Jane Fraser's leading the charge here, of course. And I think it's a very big, complicated job. It's turning around an ocean liner. There's early progress, a lot of heavy lifting, as I said, to do. But if she can succeed and the management succeed, this stock is definitely undervalued and it has great upside. But it's been a value trap for many years, so we'll have to wait and see.
Gerard, I went to a seminar once at a firm long ago called Tucker, Anthony, and R.L. Day, and I was lectured that banks are supposed to return nominal GDP plus a little bit. I'm going to center tendency is that making 8, 9, 10% once in your lifetime. JP Morgan has turned that upside down. You didn't see this coming. You're the expert, nor did anybody else. The returns of 10 years, of 20 years, are 15% or so. Their 30-year return is solid double-digit return. What did Harrison, what did Dimon get right?
It's really Jamie Dimon. I think you could give Harrison credit, I guess, for merging with Bank One when Jamie Dimon was their CEO. And of course, Dimon has taken over since then. And it's been his steadfast focus on delivering for shareholders, both through expansion and growth, but at the same time, controlling expenses. They also have done a very good job in diversifying their revenue. Their consumer banking business, similar to Bank of America, is very, very profitable. On top of that, they've got a very strong capital markets business. The Bear Stearns acquisition, which was very difficult in early years because of the reputational problems that came along with it, has worked out extremely well for them. So I would say the diversity of revenue, Tom, and the focus on delivering for shareholders.
But back to Andrew Jackson, who you covered, years ago, Gerard. I mean, are they the 5th bank of the United States? Over the holidays, somebody said 1 out of 5 profit dollars comes to JP Morgan. They're building their palace on Park Avenue right now. I mean, to the Butch Cassidy idea, who are these guys? Are they the Bank of the United States?
I don't think they're the Bank of the United States, but they've done a great job in delivering for their shareholders and for their employees and their communities as well. It's been a big growth engine for the company, this economy, the global economy as well. And again, it's this leadership that they have under Dimon and his executive management team. And Tom, many of his senior folks have left JP Morgan and are now CEOs of other banks like Charlie Scharf at Wells Fargo. And so he's got a very deep bench and they execute. And that's the key, Tom. Banking is a commodity business, as you well know. It's all about execution, and JP Morgan has executed extremely well.
What is the business model, though, that you want to execute as a big U.S. bank, Gerard? And this, I think, is one of the key questions that we had during last year when the rise of private capital, private equity, private debt really was challenging the capital markets activity of certain big financial institutions. Can the JP Morgans, the Bank of Americas, the Citigroups get into the private debt world that in some ways has been stealing their lunch?
I think it can, Lisa. And when you think about it, and you're right, the private equity, private debt area is certainly growing much faster than the banks. But believe it or not, the shadow banking industry has been taking the bank's market share for 40 years. You go back to the early 80s, and you look at the market share that the banks had of lending into the United States, it was well over 40%. The private or shadow banking market was in the low 20s. Today it's completely flip-flopped. The bank's market share now is in the low 20s, and the shadow banking is in the over 50%. So the banks have done it through consolidation. you know, when Tom and I were young, we had over 18,000 banks in the United States in the early 1980s. Today, there's 4,600. JP Morgan has been a big beneficiary of that, and they've been able to create those efficiencies. So yes, they can compete, they will compete, and I don't think that the banks are going to be put out of business, but certainly they don't have the market share that they used to have. But we have to remember, too, the economy has grown dramatically in 40 years, and they have a smaller slice of the pie, but they're more profitable than ever. Not just JP Morgan, but other banks as well.
What about the smaller banks, given the fact that you're talking about a bigger slice of just overall activity? You haven't seen that so much in the smaller banks, and with rates remaining high, you're going to have real commercial real estate pressures as well.
It's interesting. It depends on, you know, how small the bank is and who owns it. I've always maintained this banking system we have in the United States is obviously very polarized. You got the very small banks at one end and the very large banks at the other end. And if it's if the owners of the smaller banks, private banks or mutual savings banks or another group of banks, if their owners are comfortable with earning returns on equities of 4 or 5%, and they're not going to sell the bank, as long as they have FDIC insurance, they're going to remain in business indefinitely. On the other end, if you do have a bank with $30 billion in assets and it's not earning up to what its shareholders want it to earn, then they're going to have to consolidate. So consolidation is going to continue. We're in a pause right now, but the long-term trend has been consolidation, and the industry will continue to consolidate in the future, in our view.
Jared, let's finish on Washington, if we can. I was speaking to your colleague, Amy Silverman, just yesterday, and we were reflecting on a line that came from Lori Calvasina, who I think described presidential politics and the election on the horizon like staring at the sun. I just wonder if that's what it's like for you. Have you given any thought to changes in leadership in Washington and what it might mean for the companies that fall under your coverage?
John, it's a good question because it's going to be the topic du jour this year, of course, with the election coming. And what we can say is that under the current administration, there's been more regulation of banks, particularly with the Consumer Financial Protection Bureau. We don't know who's going to be running, you know, just yet in November, but if Trump is the candidate for the other party, the Republican Party, and if he was to win, his administration had less regulation for banks. So if that administration was to come back, you would have to expect they would change the heads of different regulatory agencies in 2025, and there probably would be less regulation for the banks as we move forward.
You know, John, I think Bloomberg Radio's missing it today because we're seeing the fireplace with Gerard Cassidy here on Bloomberg Television.
The warmth of
Cassidy.
Cassidy.
Talk about inflation. South Paris, Maine, $325 per cord of red oak. That's delivered to Shea Cassidy. And he's popping like 8-9 cords a winter. Think about that. I mean, it's adding up.
It's expensive, but don't you love the smell?
The smell's great. The damn dog is over by the fireplace.
The smell.
You know, his dog's called Elizabeth. We won't go there. And
we won't go there. Jared, thank you. Jared Cassidy of RBC Capital Markets. Thank you, sir. Coming up a little bit later on Bloomberg TV and radio, 10:30 a.m. Eastern Time. A few hours from now, Morgan Stanley Executive Chairman James Gorman, as he leaves his post as CEO, an exclusive conversation with Bloomberg's Sonali Basak. Lisa, that is the exit interview with Sonali a little bit later.
Yeah, with Tim Pick coming up and taking over, Ted Pick, excuse me, taking the helm of the big ship that frankly has beaten Goldman Sachs for so many years. Can they continue to do that in 2024?
Looking forward to the conversation. Looking forward to this as well. Up next on the program, Phil Camporelli of JP Morgan Asset Management. From New York, equity futures session lows were down 0.4%.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffman arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but ON's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything.
I think this will probably go down in history as one of, if not the largest financial crimes ever.
I cannot imagine a scenario where $8 billion just disappears.
Bankman-Fried has pled not guilty to multiple fraud charges.
Sam was just too important in the crypto community.
When someone says, I'm going to give $1 billion in the next 2 years, like that catches everybody's attention.
As time went on, their ideas got like weirder and weirder.
I don't think he even had almost a conception at some points that it was wrong or right. I think he just had the mentality that he has to win.
This committee will not stop until we uncover the full truth behind the collapse of FTX.
Sue, Mark.
Are you in? I'm in.
I'm in.
We're in.
Will this be the last of its kind? No. This is the nature of capitalism. Get over it.
I do think the Fed is probably going to be disappointing here relative to the speed at which rate cuts are priced into the market.
I don't think the Fed is going to deliver what the market is expecting.
You start to see data that is a little bit more inflationary. That narrative on how much the Fed's going to cut has to change.
The Fed has been remarkably sensitive in practicing its mandate. I think it wants to keep it that way.
You've got the Fed wind at your back in 2024.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio and television. Day 2 of a new year, a struggle in the equity markets, the world turned upside down. And thank God at 10 a.m. this morning, we got the John Farrow statistics. You think ISM matters?
ISM services matters. Manufacturing less so. ISM manufacturing's been sub 50 since late 2022. If we were following that to make some kind of trading call on the broader economy, the broader market, you'd just be dead wrong.
Yeah.
Outside of ISM manufacturing, Tom, things are pretty decent if you focus on jobless claims. And this week is all about the jobs report. Payrolls on Friday. The estimate at the moment about 170. Some 190s out there from Citi, from Goldman. Right. That's pretty decent. After the big interest rate hikes we've had so far, this wasn't what we expected to start 2024
I'm going to look at the headline data, wage inflation. Wage inflation just as said, do not pass go to the Fed so far. They can't move until wage inflation comes down.
They're teasing it, though, aren't they?
Yeah.
Chairman Powell flirted with the idea that maybe they're starting to discuss it, which tees up the Fed minutes, Tom, later this afternoon, 2 p.m. Eastern Time.
An underpinning here, and Lisa, this is your wheelhouse. It's the idea that the bond market turned upside down, the credit market, private equity, private credit. Our Canadian shop today talking about certain transactions up in Canada. What is the stress in the credit market right now?
Non-existent. That's where it is. I mean, basically what you've seen is everybody flooding into credit riskier and riskier as the year went on. The question is whether that's warranted. A lot of people saying it is because basically we've been able to handle these rates, and if they're going down, well, fantastic. Kumbaya. Let's refinance and get on our way.
I mentioned this Anton Gar's effort in the FT today. There's a wall of cash in private equity looking for a warm spot, more private credit. But at the same time, they have a wall of cash invested that they're trying to get out of, and that's stopped this year, right?
Yeah, if you take a step back, right, so there is sort of $2.5 trillion on one side of cash and private equity and $2.9 trillion of exits that they need to do for the companies they're actually invested in. If you take a zoom out kind of approach, there has been stasis in a lot of capital markets over the past year because of how high rates are. When things start to defrost, which direction will they go? Will you start to see valuations truly reset, given the fact that we haven't really seen the visibility? Or will we start to see, you know, all things to the moon, everything's a go, and inflation continue to reignite?
You and I talk about this, and she just goes, well, we need to see exits. What in God's name is an exit, Jack?
Exit from what?
IPO market? I don't know.
Potentially some business for the banks, TK. Going public.
Yeah, well, it's a part of global Wall Street. It's been really, really soggy here. And with the turmoil that we see in the equity markets, futures negative 21. John, the VIX still hasn't come back. 13.86 on the VIX is still not like a two-day
Wish
move.
we had the Bramo cam up for when you weigh in. It's like this deep breath. It's like yoga trading, like relaxation.
Please,
like
stop.
deep
No,
breath, just
no.
to kind of like reset, stay cool, stay calm.
No, I just, you know, I'm glad that you defined exits. Sorry to use jargon.
Exit.
I think everyone.
I think that I could take an
Anyway,
we're going to exit.
price action looks like this. Let's get a screen up on the S&P 500. Equities down by 0.4% on the S&P. Keep going back to this call from Max Kantner of HSBC.
Yes.
Look, he was bullish all of last year. And you're right, Tom. I remember sitting down with him early on in the year, and he was talking about the biggest risk being the upside risk in markets, and he was right to call that out. Was long equities, was long credit, when everyone was talking about being maybe overweight cash, receiving 5%. This is what he's saying this morning. The biggest risk right now, and it's not a deterioration in earnings activity. What he's looking for is another repricing in rates. And if you get the kind of numbers that Goldman Sachs and Citi are looking for in a payrolls report on Friday, you keep seeing that through the year, and it keeps pushing off the idea that the Fed cuts anytime soon. Maybe you do get the Max Kantner.
And I'm going to go into short-term rates as well, and maybe away from what the economists are talking about. Their 10-year real yield, 1.75%, and Gennady was just on with TD Securities saying that has to come down. I don't see the oomph there to get it down to 1.5 or 1.2%.
Took you this morning, Tom, 4.35, 10-year at about 3.98, pushing 4% this morning on a 10-year Treasury.
What we're doing here, folks, equities, bonds, currencies, commodities, I believe that's multi-asset. Phil Camparelli joins us right now with JP Morgan Asset Management, multi-asset portfolio. Which asset is the best to be in right now?
Equities. And it's pretty simple. So we have a Fed who did their last hike in July, and we have an economy that we think only has a 20% probability of going into recession in 2024. If you put those two things together, we have a 7% overweight to equities right now. And that's the biggest overweight that we've had in equities since before this crazy tightening cycle began in March of 2022. And there's a good reason why. I talked about the no recession view, but we can now play defense with bonds. And I can exhale saying that because we really do believe that that the risk has shifted from inflation being the risk and rates being a risk to, if we're wrong on the equity side, it's probably because growth is slipping and we get the protection in bonds. So we're trying to make diversification great again here.
I just brought up the Bloomberg Total Return Index, which is a really, really good, elegant chart, and it's right up against resistance here. We've had, as you say, bonds and historic disappointment in bonds. Is it all clear now for total return on bonds?
We think it is because I think there's a big difference. You guys have been talking a lot, and we've been talking a lot too about, well, maybe they don't ease this much. Like maybe they don't do this March easing. I think that's fine, but we just think it's a very low probability, Tom, that they're going to hike again. So that's a regime shift. Because last year we were saying, okay, how many more tightenings do they have left? Now this year we're saying maybe they don't ease as much, and that's different. And if I could just put a bow on the fourth quarter for a second, because I have the chance to, and I'm so happy about it. My favorite portfolio, the 60-40 portfolio, Tom, up about 10% in the fourth quarter, and the 3-month T-bill index up 1.3%. And that 3-month T-bill is still my biggest competitor. It's not Fund Family X, it's the 3-month T-bill.
The 60 and the 40 is not meant to work at the same time, though, right?
But when they go up together, we're happy.
Yeah,
when they go
news,
down together, we're really upset.
That's the problem. But you're saying now, as we come into this year, we might see a difference. You're saying defense is back in bonds.
That's right.
What's changed?
What's changed is the fact that, again, that primary risk of, is inflation a problem? Is the Fed going to raise rates has now shifted to the fact that they're worried about their dual mandate. Their dual mandate is full employment and price stability, and it's a departure, John, from where we were from March of 22 when they were playing catch up on inflation. Core PCE is at 3.2%.
So, given the fact that you have the biggest overweight position in equities right now, since before the Fed started its rate hiking cycle, are you basically viewing that the sell-off right now as a buying opportunity, or are you basically seeing this as something you want to wait through before adding more?
So, Lisa, I think you'd find some sympathy to this. Rates are on the wrong side of 4% right now in the 10-year. So I think there is some sort of realization here that maybe we overdid the easing and there could be some near-term volatility on equities, but that's noise. The real signal is the fact that the U.S. economy is on strong footing. We think the soft landing, I think that all the pessimists has finally thrown in the towel on the recession in 2023, being that we're in January of 2024 now. So that's where we stand here. It's not that the equity market is going to suffer from a growth story or a huge labor market slack or business caution. I think it's just the fact that it overdid it a little bit on the rate side. 10-year notes should probably be between 4 and 4.5% in the first quarter, and then maybe the equity market gives a little bit back there.
Given that it might be more of a rate story than anything else, it's notable to me that tech is underperforming as much as it is. And it raises this question about whether you could have the recovery that you talk about and an underperformance on the index level because big tech doesn't cooperate. Do you think that that could be something that happens this year?
I think that could have some legs, Lisa, for sure. So if you look at the cap-weighted S&P 500 valuation at 19 times, equal weight is at 16 times. So we believe that if you're now in a, everybody's worried about high for longer, high for longer, high for longer. Now it's high for not that much longer, right? All of the other S&P 500 companies that were worried about two things last year, recession or high interest rates, those companies are going to have a chance. Those are the companies we're focused on, Lisa, whereas the big tech companies benefited in March from Silicon Valley and the regional bank crisis, because Apple doesn't need a loan from regional bank, and they benefited from the fact that they have tremendous free cash flow that was generating all that income, and they are higher quality. So I think there could be a rotation, and we're positioning for that.
Okay, but the rotation, this is really critical. You mentioned the 60-40 triumph beating by 900 basis points, 800 basis points, your bogey. That's all great, except to most of our viewers and listeners, Apple is the portfolio. I mean, even if they don't own it, psychologically, that's a bogey. The Magnificent Seven, does that idea just go away?
No, it doesn't go away because those are really high-quality companies, Tom. So it obviously doesn't go away. I just don't think it takes the leadership this year that it did last year because the fundamental story has changed. Folks being worried about high interest rates and free cash flow to now you have chances like, financials in your last segment, I think was a great cyclical story that was under-owned this year. Things like that can make more sense than the Magnificent Seven. Those companies don't go away.
Well, you set this one up for us. This is an easy one. It's that financials ex JP Morgan, because JP Morgan's done really well. I know you can't do this. JP Morgan's done really well. The rest of the sector struggled. It's been a struggle. Why is that going to change?
Yeah, and I think that was more around the fact of, do we have a recession? Right, and I think in one of your last segments, I think it was a really good story. In a risk-on trade, banks usually do well. Okay, and I think that's what we're seeing, what we're trying to set up for in 2024. This all goes back to the factor, are you in recession or are you not in recession? And we have a very low probability of recession this year, and the unemployment rate we think stays at around 4%. That should be good for banks.
Let's finish on earnings if we can.
Yep.
So your earnings come out in a couple of Fridays. We won't talk about that, of course. JP Morgan just around the corner, by the way. And then we're going to get the tech players, the likes of Apple in early February. Yep. What are you looking for the fourth quarter as we hear from those companies in the next couple of months?
Yeah, so I think our earnings estimate, John, for this year is about 10% on earnings. And I think that what we're going to hear from these companies is, I think, a little bit of a sigh of relief on the rate side. And I also believe that the U.S. consumer continues. You mentioned ISM services. I couldn't agree with you more. I mean, ISM manufacturing, you ask people, that have been around for a long time, they think that matters. We are a service sector economy right now. So I really believe that they're going to be focused on the consumer in the fourth quarter. That's held up very, very well.
Phil, good to see you. Happy New Year. Thanks for coming on. Phil Camporelli there of JP Morgan Asset Management, looking, Tom, for a change of leadership in 2024.
Well, there's a zillion opinions out there, but the basic idea to the select few that own the Magnificent Seven, I'm not one of them, but the basic idea is if you own them, what do you do? Do you walk in and sell them? You're going to tell somebody to sell Microsoft right now?
Yesterday they were selling them. They were
selling. I believe they're selling them today as well.
Yeah. If you are just joining us, welcome to the program. Here's the state of play, the scores, if you will, on the S&P 500, pulling back. We're negative here by 0.4%. Yields are a little bit higher by 4 basis points, 3.97 on a 10-year, getting closer and closer to 4% in about 17 or 18 minutes' time. We'll catch up with Torsten Slok of Apollo. Lisa, that conversation just around the corner.
I'm curious to see about some of the softening that we were hearing about from Tracy McMillan of Wells Fargo. This question of, is it enough to both bring inflation down but also support some of these pretty robust profit expectations and the sort of rotation that people are talking about? I mean, right now the economics is really going to be front and center, and you asked the most important question, which is going to be the indicator that you need to follow that's going to be actually signal and not noise?
Well, in the last 12 months, it's been jobless claims, Tom. Any reason for that to change anytime soon?
Yeah, I'll go with the jobless claims. To me, it doesn't have the depth of some of the other statistics. To me, the fundamental issue, I think, of Tom Purcell here of PGIM is the wage dynamic in America. It really, it's better, but it really hasn't broken, John. We're not beyond the pandemic wage surge that we saw.
That's the Neil Dutta call. Ultimately, real wage growth is going to support the consumer, and this economy is the consumer. And we saw that in discretionary going into year end. Some big names had some big moves. Thinking about the airlines also, really strong finish to 2023. Coming up very shortly, Henrietta Trays of Veda Partners. That's coming up next. The broader price action, as you know, pulling back yesterday, pulling back again this morning. We're down by 0.4%. Session lows on the S&P 500 after some pretty stellar gains through 2023. Gains of more than 20% on the S&P, more than 50% on the NASDAQ 100. From New York, this is Bloomberg.
To keep reading World Cup. This is a 3
as the economic picture
covering the intersections of Hollywood, Silicon Valley, and beyond.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
The jobs report last month beat estimates.
That is a stunning number.
That is what nobody was expecting.
The bullish train has left the station.
This is what Powell does not want to see.
This Friday, Tom, Jonathan, Lisa, and Mike will bring you crucial data and expert analysis at terminal speed.
You're really not seeing the level of restrictiveness show up yet in the labor market.
Significant job growth and high labor force participation.
There's a very strong chance that the market is mispriced for 2024.
The December jobs report, Friday on Bloomberg Television and Radio.
People are not particularly pleased with neither the options they have, how the parties operate, or how the system operates more generally. Looking at the favorable ratings, which is really a really good proxy, I think, at this point of the contest to see who's gaining traction with the public, really none of them are. Nobody's really shot through the roof and impressed or wowed. Of course, January 15th is just down the street. A lot can change, particularly when those first results start coming out from the caucuses. But right now, nobody's dominating.
That was the brilliant Mohammed Yunus, the editor-in-chief at Gallup, speaking on Balance of Power yesterday on the mood of the American public as we enter a presidential election year. This line from him, Tom, jumped out to me. If you look at favorable ratings, which he says is a really good proxy, I think at this point of the contest to see who's gaining traction with the public, really, none of them are. None of them are. There is a feeling across this country, away from the fringes and the extremes, and you just go to the centre, Tom, a great disappointment at the candidates on either side that are going to be facing off potentially for the president of this nation at the end of the year.
We've faced this many, many times across 250 plus years, and the answer is there's a point where negative ratings really, really matter. And as we get towards the election, the primary season beginning in New Hampshire and Iowa, Anne-Marie Horton leading our coverage on that. And the bottom line is we're into the season where the negativity needs to be measured.
Well, to me, what I find interesting is because of the sort of disaffection of both candidates, no one's really talking about the fact that we are less than 2 weeks away from the beginning of the election season, where we have the Iowa caucus of the Republican Party. And then 10 days after that, we have New Hampshire, where suddenly we get a real read on what the landscape is going to be, whether Nikki Haley actually can gain any traction whatsoever on the Republican side, and President Biden, what kind of feel there is there. No one's really talking about the challenges of former President Trump to some of these bans. I mean, there are a lot of things going on under the surface, and people seem to be shrugging it all off.
It's like right here. I talked about the response from market participants, that line from Laurie Calvasina, the conversations, Tom, about the U.S. presidential elections for people in markets right now. It's like staring at the sun. It's like staring at the sun.
Yeah, I like that. Frankly, I like it. And to Lisa's point, I think this is important. I don't see a drum roll to New Hampshire, and I don't know what that means. I really don't know how to interpret it. Let's get to it right now on the political season. Henrietta Trey's joins us, Economic Policy Research Director at Veda Partners, knows where Concord, New Hampshire is on the map, the distinctions between Manchester and Concord. Henrietta, I look at the dynamic right now that John just talked about. I got a lot of retirements going on in Capitol Hill. What are we going to see in the first 90 days politically on Capitol Hill?
You're going to see a tremendous amount of activity and noise. We have 2 potential shutdown dates, a looming sequester of 1% cuts to defense. And then you also have, obviously, the start of the various trials for former President Trump, the first primaries, and then also a deal on Israel, Ukraine, and southern border aid. So there's a lot of policy. But I would maybe just interject a little bit. I think the opportunity for investors to learn so much in the next 90 days is being underappreciated. You have about a third of the country who's going to decide the election, from the independents, undecided Dems who are maybe holding out for another candidate, and about 8% of Republicans. And they're all going to start making choices after the first 3 primaries. So this next 2-3 month interval is going to be such a momentum opportunity for either candidate. And what I've sort of stressed to our clients is that one of the candidates on the presidential ballot is at his floor, and that is Joe Biden, with negative 21, negative 27 points down versus maybe his June polling on certain data metrics. And then there's former President Trump, who's at his ceiling. So as we go into the first quarter of this year, which candidate would you prefer to be? And I think there's a lot of opportunity for read-through and forecasting that is pretty stark.
You earmark Super Tuesday in early March as being politically important. Just as a general statement, reaching into the summer, do you have any idea what the conventions look like? Or will they be absolutely original in our history?
Well, I don't think there's an opportunity for Trump to be ousted after Iowa, New Hampshire, Nevada, or South Carolina. And what we see from the Republican challengers is that they're sort of hanging on. And I think that the hope is that they get to the convention period this summer, and maybe Trump's various 4 federal indictments, 91 indictments, 4 trials, improving economic data, and maybe fallout from a scenario where Trump is front and center and Biden's approval potentially emerges as a positive, and then there's a party shift. I think that there is a very low odds that Trump is not on the ballot either in the primary or in November and is the Republican nominee. But if there's any opportunity for change for Haley, DeSantis, or any other candidate, Chris Christie's obviously also trying to hang on there. The next opportunity is not till the conventions. And I think that presents an opportunity for it to be interesting. But other than that, I don't see an opportunity for change from the Republican side, and Biden is the Democratic frontrunner.
Henrietta, you mentioned all of the legal challenges to Donald Trump. So far, that's all been a benefit for him from a fundraising as well as popularity standpoint. Is there any signal that could change?
Well, you got to ask yourself, who is it a benefit with? Is it a benefit with Democrats? No. Is it a benefit with independents? No. It's a benefit with Republicans. So the shocker is not really all that shocking. Republicans support Trump, and that's what they're showing you. So as he becomes more embattled, he secures his foundation within the base, but that's not sufficient to win the election. You need the independents. One of the things I'd encourage folks to look at as we face the uncertainty of the trials is the fact that the Supreme Court has decided to weigh in on abortion this summer. So we're going to get additional inflection points that have for the last 3 years impacted the way independents and Democrats and Republicans turn out. And abortion, I think, overshadows any of the trial stuff, which has as you point out, shored up Trump's base. But that's to be expected. Republican voters love Trump, and they exhibit that time and time again.
I kind of smile when we talk about leadership change within the market composition, because we're going to get such a massive leadership change maybe in the United States, where we get the first rematch once again of two presidential candidates since 1956, I believe. Henrietta, how should the market be viewing this in any other way other than staring at the sun, as John was just saying?
Well, again, I think that there is a lot of opportunity for directional indications in the next few months. We're going to get so much clarity in the next 90 days. Don't discount that. You know, one of the things that I recall, having done this for a long time, is in 2016, people were convinced Bernie Sanders was going to be the nominee. And then in 2020, they were convinced Bernie Sanders was going to be the nominee. All the predictive data sites said that. And it's because there was a failure to read through to what the polling numbers are telling you. They're telling you right now, people are open to another alternative. In 3 months, there's not going to be another alternative. So where do you see historically those voters going? To their base, but in this case, I would be talking about Democrats because Biden has the biggest gap within his caucus, but then also independents. Where do they go? Well, since 2016, they've gone to the Democratic Party. So you'd have to overlook 2018, 2020, 2022, and then assume that it would somehow be different in 2024, and that sort of defies logic.
Well, let's finish on this question then, and tell me if it defies logic to think about this. Do Democrats need a plan B?
First of all, I don't think there is a plan B, so I doubt it. In the scenario that they do, their convention would look a lot like the confusion and momentous occasion that I described for Republicans, where you have a Gretchen Whitmer or a Gavin Newsom sort of emerge at the last minute. But again, I think the investors have also overlooked the fact that the next in line is the vice president, and that's Kamala Harris. And so there would be a three-way race, I think, between those three candidates if you were to come to the convention for Democrats and need to have a new candidate.
Interesting. Henrietta, thank you, and Happy New Year. As always, good to catch up. Henrietta Trace there at Vader Partners. TK, your thoughts on that last question. Do we need a plan B?
It's a really sensitive question, and I think everyone awaits, and it's a calendar item. I can't emphasize enough where many of the questions that we have to the left, to the right, in between as well, are calendar items. And Lisa nailed it earlier, saying that the calendar's disrupted for whatever reason here. I don't see the anticipation. Yes, Iowa, I get it, but I'm sorry, East Coast bias, New England bias. I'm focused on New Hampshire, and I'm sorry, the focus is not there as it's been in previous cycles.
I wonder how much Henrietta's line is actually one that the White House is looking to as well, which is right now you're seeing President Biden's floor and you're seeing the former President Trump's ceiling, and that's going to shift over time. What happens if it doesn't? As she said, there is no plan B. Do they need one? Unclear. There isn't one, period, full stop.
If you ask them, they'd be like, we don't need one.
Exactly.
But I'm sure there's someone out there saying, do we need one?
There are a lot of people saying that.
Tom King with an East Coast bias. I'm in shock. Absolute shock. Shocking. Toss and Slug of Apollo.
Truth seekers.
Coming up next from New York City. This is Bloomberg.
on the product may read Made in the USA, but the sign on the CEO's door often says Made in India. Alphabet's Sundar Pichai, Microsoft's Satya Nadella, IBM's Arvind Krishna, Micron Technology's Sanjay Mehrotra, and that's just the start. Add in the chief executives of Adobe, Deloitte, Gap, VMware, and that doesn't count Indians running companies all over the world. Why have so many Indians risen to the top? Vinod Khosla points to India's incredibly competitive education system. If you can survive the pressure it takes to get into one of the Indian institutes of technology, it gives you confidence to handle American universities and later the business world. Meanwhile, the belief in India's ability to produce so many tech wizards is reinforced every year. Indians make up about 3/4 of the immigrants receiving coveted H-1B visas for the U.S., and it's a safe bet that some of them will eventually find their way to the C-suite.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg. Context changes everything.
Equities pulling back here on the S&P 500, just off session lows, no drama. A bit like yesterday, just adding to the losses of yesterday off the back of nothing really. On the S&P 500, negative by 0.3%, yields higher by 4 basis points, 397 on a 10-year. A little bit later this morning, we get some economic data. We'll get the ISM, we'll get some Fed minutes this afternoon. On to payrolls on Friday. Before we get there, we'll get some jobless claims as well. Get some Fed speak too. We're light on Fed speak this week, but here's a flavor of it coming from the Richmond Fed president, Mr. Barkin, with this to say: a soft landing is increasingly conceivable, but in no way inevitable. Lisa going on to say the demand, employment, and inflation all surge, but now seem to be on a path back towards normal levels.
This, to me, is maybe some mediocre pushback. You're not really seeing any kind of reaction in the market, but basically saying, look, pump the brakes. This isn't an inevitable kind of outcome at a time where everybody has priced this in to perfection. And that's sort of the balance that we're going to hear in the minutes as well.
Trying to introduce maybe, Lisa, Tom, some two-way risk to this conversation around rate cuts as we start a new year.
That's a really nice way of putting it, and that there's an asymmetry here over the last 90 days, and certainly after Powell's extravaganza a few weeks ago. And the answer is yes, they want to become more symmetric about the outcomes. The headline here, no surprise, Barkin saying, higher interest rates, more additional rate hikes. That remains on the table. So that's creating that symmetric approach that they dream of. Maybe dream is the operative word.
And Mike McKee can talk to us about the dream for the year ahead. He joins us now, our international economics and policy correspondent. Mike, let's talk about the Fed speak, the minutes later, and the data as well. What are you looking for?
Well, everybody is going to be looking for any kind of indication about timing of rate cuts and what they might say about the number of rate cuts. Barkin talked about that in his speech this morning and said that all of this is in the context of their forecasts being right. They put out forecasts for inflation and unemployment and growth. At the same time, they talked about the possibility of 3 rate cuts, and he says that the rate cuts depend on the forecast being correct. And as you note in his pushback, he says to the folks on Wall Street, I would caution you to focus less on the rate path and more on the flight path. Is inflation continuing its descent? So I think the pushback idea is still out there. The Fed trying to get everybody to realize that this is basically data dependent. And that's, I think, what we get out of the minutes today, too.
Mike, on Friday, when you lead our coverage here on the wall of data that we see, to Barkin's comments, we're going to get wage inflation data. Is that disinflation right now? Are we seeing wage inflation come down?
Well, we're not seeing disinflation. Really, what we're seeing is a very slight drop in the month-over-month gain, which, because of the higher pay increases that people got last year is bringing the year-over-year level down. It's now around 4%, and the Fed's looking for 3 to 3.5%. So it's getting there. They don't seem to be too worried at this point about a wage push inflation coming up. They're more concerned about other aspects of inflation, which will make CPI next week very interesting.
All I can say is I'm still looking at these Barkin comments, and I keep thinking, John, the horse has left the barn, right? I mean, at a certain point, he's trying to push back, and we're not hearing it in the market. The market's saying, okay, you can say that, nice try, and they're not doing anything. I mean, that's basically what I'm seeing right now.
Did you see the Mike McKee tweet storm over the Christmas holiday? Did you see that? Mike McKee, do you want to tell people about it who maybe didn't read it or don't follow you on Twitter about what's happening right now, this tug of war between markets and the Fed?
Well, I welcome everybody to go back and look at it on Twitter or on Threads. But basically, to boil it all down, what the Fed does is put out a compendium of 19 different forecasts, and we pick the middle number, and that becomes basically the median that everybody focuses on. But it's not a plan. It's 19 different forecasts. So you have to look at it in the context in which Tom Barkin is talking about it, that everybody says, here's what we think will happen. And if what we think happens does indeed happen, then this is what we will do, or this is what each of them would do. And if you look at the dot plot, and John, you and I have talked about this before, the dispersion of dots is still pretty wide for next year, from 6 to 1 or none. And so there's not any certainty on the Fed about what they're going to do.
Mike McKee, thank you, sir. Appreciate it. Mike McKee, they're breaking it down for the Federal Reserve. You can think about this for the forecast as well, Tom. The median always masks a bigger story. The range often of the Federal Reserve is pretty wide. It's pretty wide right now for 2024, just like the forecast for the S&P 500 year end. We can talk about the average, the median. At the high end, you've got 5,200. At the low end, you've got 42. We're talking about a 1,000-point spread.
Yeah, I would say, and I think the pull over to the equity markets is really apt in that, off of the pandemic, we have just a great unknown out there, is how I'd put it, into all of our coverage, including, I believe it's January 11th on inflation. Right now, our conversation of the day, synthesizing all this together, Torsten Stock is chief economist at Apollo Global Management. Torsten, I'm going to pull in here a whole bunch of threads. The Bloomberg Financial Conditions Index is showing massive accommodation. And yet I look at the old LIBOR, the new SOFR, SOFR, and I'm seeing huge restriction within the short-term paper market, tensions on Wall Street, and illiquidity on Wall Street. How urgent is it for the Fed to make some direction on a March cut, or dare I even say a January first cut?
Well, it has a number of different dimensions. First, there is a dimension on the real economy. It's clear that the Fed pivot has eased financial conditions dramatically. And this begins to run the risk that we might see a repeat of what happened after Silicon Valley Bank. Remember, Chris Waller just said a few weeks ago, the easing of financial conditions in Q2, that boosted GDP growth to 5% in Q3. Could we see the same now, where the easing of financial conditions after the Fed pivot might actually be boosting the housing market, the labor market, services inflation, goods inflation? We are not out of the woods when it comes to battling inflation. So on the real economy, absolutely, the easing of financial conditions is very supportive. There are some issues when it comes to the plumbing, when the tightness, as you're highlighting, in very short-term markets, and the Fed for sure has to play this difficult tug of war between, do we want to ease financial conditions on the risk side, or how much can we ease financial conditions in the very front end of the curve? But this is the challenge for the Fed at the moment that you're highlighting.
Torsten, you didn't listen. They didn't respond to the idea of financial conditions. They didn't seem to think it mattered at all at the last press conference. Why should it matter now? I mean, we're going to actually hear them come back and say, actually, just kidding, about that financial conditions question.
Well, they were debating in October and September, well, maybe financial conditions have done a lot of the work for us. And now they're saying, well, maybe financial conditions, it doesn't really matter because it can fluctuate so much. So I still think that it's a little bit inconsistent what they're saying. When the data dependency, it only talks about the real data, whereas the financial conditions impulse, if you take the easing in financial conditions that we have had since the Fed pivot and stuff it into FERPAS, the Fed's model of the US economy, you will get a boom of up to 1.5% growth over the next several quarters in GDP. It's going to be very supportive as a tailwind to the economic outlook.
Although we did have Gennady on earlier of TD Securities, and he said, even with this idea that inflation could remain stickier, that we could get this ongoing growth, the Fed could still cut rates and still be restrictive, given the positive real rate Do you ascribe to that kind of thing, or do you think that just means many fewer rate cuts going forward for the Fed?
I think that's absolutely right. That we have, of course, for the better part of the last year, we have talked about higher for longer. Now the conversation is more restrictive for longer, because they can still be restrictive if inflation is coming down, because real interest rates is what matters. So if real interest rates are still positive as inflation comes down, the Fed can accordingly also gradually begin to lower rates. But note also that if you look at the outlook for SOFR futures, as also Tom was mentioning, you still have that the bottom will still be around 3.5–4%. So one very important conclusion for asset allocation is that we are not going back to zero. We have still higher for longer in the sense that the level of interest rates, the level of the risk-free rate on page 1 in your finance textbook will be significantly higher for the next several years than where it was from the period from 2008 to 2022.
Let's try and get to the heart of what we're discussing here, the interest rate sensitivity of the US economy.
Exactly.
Now, what we've seen over the last 2 years is rates go up aggressively and not slow down the economy. And what you're suggesting is that as rates start to come in and financial conditions ease, that the economy picks up again. Can you help explain that to people, why higher rates haven't slowed the economy down, but easing financial conditions will boost it?
Yeah, but what's very important in that debate, and that's also taking place on Twitter and X, of course, here at the moment, is that
it is
I live, very critically
sophisticated
important to remember that that is significantly a function of whether you talk about the interest rate sensitive components of GDP or the non-interest rate sensitive components of GDP. If you split GDP into the cyclical components and the non-cyclical components, the main component that is sensitive to interest rates is housing. And housing did respond dramatically to higher rates. So this whole idea that the economy didn't respond to higher rates, that's just completely wrong. Of course, the economy responded to rates. It was the interest rate sensitive parts that responded to rates going up. Housing started slowing down, but the non-interest rate sensitive components, in this case, travel, restaurants, hotels, after COVID, had such a long tailwind that more than dominated the slowdown in the housing market. So splitting that debate away from the academic textbook, which we all love, is so important because it becomes so critical to think about, did the parts of the economy that are sensitive to interest rates, did they actually respond? And absolutely, in particular housing, capex, also commercial real estate, things that are sensitive to interest rates, they did absolutely respond to when interest rates went up.
This is a fantastic explanation, so let's build on it. Let's project this out. What are the forecasts now for you for GDP in the next couple of quarters? We heard from the likes of Max Kettner of HSBC, who said the biggest risk right now is that we have to reprice rates again higher, because exactly of what you're talking about. What are you looking for in the data?
Well, if I type ECFC Go on my Bloomberg screen, I will see that over the next 6 months, we are very close to 0.4 and 0.5 on GDP for Q1 and Q2. So the consensus answer to your question is GDP growth is continuously slowing as a result of the Fed's campaign of hiking rates. The new risk that has emerged is that because of the Fed pivot, that means that the interest rate sensitive components that were dragging down GDP for the better part of last year, they might now begin to rebound. Housing, most importantly, Case-Shiller is now up 5%. Case-Shiller is a very important leading indicator for the OER, meaning the shelter components of the CPI, and shelter makes up 40% of the index. So that means that if something that makes up 40% of the index is about to rebound, we could come back to that discussion about maybe the rates markets will have to reprice to higher for longer and more restrictive for longer.
I just looked at the 2-year inflation-adjusted yield. I haven't looked at it since time began. Nixon was president. And I can use the word never over 20 years. The integran, or the duration of a high 2-year real rate, we've never seen. We had a spike in 2008 with the great financial crisis, but these sustained high 2-year real yields are absolutely unprecedented for global Wall Street. How unstable are we right now?
I would say, at least from a Fed perspective, if you just take the economics textbook out and think about what matters, it is absolutely, as you're highlighting, real rates. So real rates being at these levels would tell you that we're still in very restrictive territory. So the challenge here for the Fed is that they still want to have the soft landing, and we all want to have the soft landing. That would be the best outcome, of course, from so many dimensions. But what is beginning to matter is that they have now sucked so much liquidity out. We've gotten to a point where we are beginning to see some strains in the plumbing that you're highlighting. And that's why real rates, it has a very significant different impact on the long end and what it means for the real economy relative to what high real rates means for the front end and what it means for financial markets.
Torsten, this has been an absolute clinic. If you are just joining us, just to get you up to speed on the price action on the S&P 500 right now, negative by 0.3%, yield to higher by 4 basis points, 397 pushing 4% on a 10-year. Torsten, if you had to take a guess year-end, and it is just a guess at the moment, but I'll make it easy. Fed funds year-end, 5 handle, 4 or 3?
I would say at this point, I'm more on the forehandle. I still think we need to raise higher for longer because this whole back and forth where the pendulum swings and we suddenly ease financial conditions and we get the burst in growth like we did in Q3, we could get a burst in growth in Q2 also as a result of the easing of financial conditions. So I think we still have, first of all, the Fed pendulum swinging between dovish and hawkish, and the Fed would probably say, or the FOMC members that came out afterwards would say, this was not intended to be as dovish as the way the markets have interpreted it. And that means that for markets, it will still be a bumpy road. It's not just, excuse me, hooray, hooray for risky assets. I think the risks really here are that we will still have a lot of challenges with inflation simply not coming down as quickly. Yes, the 6 months change looks good, but don't cherry pick the 3 months, 6 months, 2 months change. Do what the Fed is doing, take the 12 months change, and what's that telling you? We still have a rough road ahead.
So if they do cut, they called it what, fine-tuning? As opposed to the start of a cycle?
Well, I think that they will say, so that's why Barkin's comments today are quite interesting, that there is probably, as you are highlighting, some dots that are different places having different views on what needs to be said. But I do think that once we get that boom as a result that's coming along of the easing of financial conditions, I think that we will be back to the pendulum swinging back for the Fed in a more hawkish direction.
Love this, Torsten. Just fantastic to catch up with you. Happy New Year, sir.
Thanks for having me.
Torsten Slok of Apollo Global Management from New York City. Equities bouncing off session lows on the S&P 500 from New York. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Gen AI is going to make it easier to access more information faster. How do we think about all those things, and where is that going to go beyond this? I actually am very bullish on technology because technology is an underpinning. It's not its own industry. It is a part of every industry, and it's actually going to increase productivity and actually make our lives better.
That was Deborah Liu, the Ancestry CEO, speaking with the brilliant David Rubenstein. You can watch the full interview tonight on the David Rubenstein Show. Peer-to-peer conversations coming up a little bit later. Just want to check in on the price action for you as we kick off day 2 of trading for 2024. Your equity market on the S&P 500 pulling back by 0.4%, adding to yesterday's losses, turning 2023 to some extent upside down just for a brief moment. Yields higher again this morning by 4 or 5 basis points, 397.44 on a 10-year. The dollar showing a little bit of strength after a year of weakness. Tom, the euro, 109.23.
Deborah Liu is the civil engineer from Duke University with a lot of experience at Facebook and then recently to Ancestry. John, Ancestry, you of course know, they show the entire criminal history of the Keene family. You can get it all laid out there as you'd like.
Have you paid up for that?
Yeah, I've paid up to find out how bad the ancestors were. David Rubenstein, what an interesting challenge to take all this new technology over to our ancestors. What is the Deborah Liu distinction?
Well, Deborah Liu is running Ancestry, which is the largest genealogy company in the world, and she's got a really good technology background, and as a result, she's applying that technology to historical records. So it's much easier than it used to be to figure out where your ancestors came from, and how far back you can trace that is really amazing. So many people have a real interest in knowing where they came from. Who are their grandfathers, great-grandfathers, great-great-grandfathers, great-grandmothers, and so forth. And now you can do that much more easily than you could years ago.
I'd suggest that they're all Baltimore Orioles fans as well. We won't go there today. David Rubenstein, if I look at what they're doing, part of it is an AI frenzy. In your discussion and in your work at Carlyle, is there part of AI that just seems to be a moment, a fad?
This company, Ancestry, was started about 40 years ago, and they relied on typical genealogical records. But now with AI, they can feed into their computers much more information, much more rapidly than before. And as a result, what used to take 9 months to feed into their computers, they can do now in maybe 9 days or even 9 hours in some cases. The result is that they have a very good ability to figure out where you came from. And for example, Tom, do you know where your ancestors are or where they came from?
Well, they're, the ones that weren't in jail. Ross came over in handcuffs. I know that. The guy named Ross. It's my middle name. He came over in handcuffs, Lisa.
Well, David, aside from genealogy and the handcuffs of the Tom Keene predecessors, the ancestors, I am curious about what this says going forward for a whole host of different companies that need to make serious investment in artificial intelligence in order to glean the benefits of this. Is this something that gets isolated into bigger companies that have the capacity to invest some real money?
Every company in the United States and probably every company in the world is trying to figure out how artificial intelligence, generative artificial intelligence particularly, is affecting their company. I know my company, we're looking at it everywhere. People are looking at it. Nobody knows exactly how it's going to affect their company. If you go back to the dawn of the internet age, many people made predictions about the internet that were turned out to be wrong. Some turned out to be right. But internet truly changed the way we live and think and exist. And I think generative AI will, and certainly will for a lot of these younger companies as well, because now they can do things they didn't have the resources to do before, because generative AI enables them to do things that they couldn't have done years ago without this kind of AI technology. So it is going to change the world, but nobody really knows how.
Do you have a sense, David, of which, especially from your seat at Carlyle, of which industries are adapting to certain artificial intelligence efficiencies more quickly than others?
Clearly, the technology companies that have a lot of technology people in their employment roles already, and people that are engineers, people that really live and die technology are probably at an advantage. So right now, the companies that seem to be doing extremely well on AI are the large technology companies like Google, Microsoft, Facebook, and so forth. But clearly, there are going to be a lot of small companies coming along in niches that nobody knows exist today. For example, there are a lot of internet companies that came along that weren't thought to be possible 25 years ago, and now they're dominant companies. Just think about this. 50 years ago, there was no Google or Microsoft and so forth, and now they run our lives practically.
David, I have to turn to Harvard. You have been a great supporter of the Harvard Corporation. Of course, you're founding of the Harvard Global Advisory Council. There was Penn, then there was Harvard, there may be others. Please comment on the resignation of the president of Harvard University.
Well, I am not now currently on the board of the Harvard Corporation. I was on it for 6 years. I became the chairman of the University of Chicago board, and therefore I resigned and retired in July 1. So I think it's good that this has been resolved. It's sad that it happened this way, but I don't really have any inside information at this point. Harvard is an extraordinary university, and I'm sure it will do quite well in the future. It's our oldest university, probably our best-known university, but I don't really have any fresh insights in it that I can give right now. I
asked Chicago graduate Lisa Abramowitz earlier. Let me ask you the same question. What is the University of Chicago getting right?
The University of Chicago has had a policy of not commenting on public events. So we did not issue a statement about what was happening in Israel. There was pressure to do so, but we've had a 100-year history of not commenting on public policy. We have a open expression policy there, which is to say almost anybody can say almost anything they want on the campus, obviously not to incite riots and so forth. but it's a different university than many others I've been associated with, and their policy is really being led right now by Paul Albasatos, who is an extraordinary chemist who's now the president of the university. And so we haven't had some of the challenges that other universities have faced, and many people are now looking to the Chicago model to see whether they can adapt that to their own situation.
David, this is kind of perhaps a bit of a personal question, but it's something that I know is a big topic of discussion in my household, which is, do you find that the people who apply to your company don't have the same kind of critical thinking skills that they have had in the past? Do you think that the higher education system is preparing kids in the same way that they did 10, 20, 30 years ago to do the work that you need them to do?
Well, clearly, people coming out of colleges and universities today have much more technical skills than they did when I graduated from college and so forth many, many years ago. So I think the universities are doing a reasonably good job. Why is it that people from all over the world want to come to our universities? We have an extraordinary number of foreign students who come to our universities. We don't see that many American students going to foreign universities. That's because we don't see that many American students going to foreign universities. That's because our students are being well prepared here. But clearly, as a student, you have some responsibility to figure out what you want to learn and how hard you want to work. You can go through almost any college with taking very easy courses and not learn very much. Those aren't the kind of people that we want. But you do find dedicated people and who do have certain skills. What I look for is not technology skills so much, but whether people actually know how to read and write and have interest and intellectual curiosity, whether they have a capacity to work hard, and whether they want to make something of themselves, not just get a salary.
And have a conversation. Get on with your peers, your colleagues, just like Tom Keene, David. Just like TK.
Yeah, joy.
So likable. David Rubenstein. David, looking forward to the episode a little bit later. Thank you, sir. David Rubenstein of the Carlyle Group and host of Peer-to-Peer Conversations on Bloomberg TV. The latest episode coming out a little bit later this evening. Just dead on, that conversation, Tom. Absolutely brilliant. Bramo, particularly towards the end, what are we preparing this generation for? What are these academic institutions doing and how have they changed over the last 10 years? What's developed in the last 24 hours is just the beginning of that conversation and certainly not the end of it.
Well, and to that point, this question of a focus on technical knowledge as the technicalities of our existence change so quickly, maybe it need to shift back to the basics of critical thinking. And that's something that has been increasingly a conversation. How do you do that at a time where the technology is shifting a lot of the experiences?
Yeah, the vanguard on this is there. There is a shift, but I would emphasize it's some of what you're talking about, Lisa, as, this course is hard, and there's not enough of...
That's a different conversation.
I got an email once from one of the offsprings, the middle child. She took microeconomics for 3 days. She emails me, this is really hard. And I said, yeah. And in microeconomics, you develop the critical thinking skills around dynamics, concept, geometry, blah, blah, blah. But the answer is, what you're talking about, Lisa, is like actually going to school and studying. How strange.
Hey, this was fun. It was nice to close out an hour with you.
Yeah,
it was really cool.
Nice
Manus Cranny holding down the fort on the Open today, by the way. I'll go through the lineup. The brilliant Manus Cranny sitting down on Bloomberg TV with Peter Cheer from Academy Securities, PIMCO's Erin Brown, Patrick Frizzetti of Rose Advisors. All of that coming up in the next hour on Bloomberg TV. Lisa and I working on a special project over the next week or so. So Manus Cranny's going to hold down the fort, so to speak, TK, over the next few days.
Well, good to have Manus in as well. You know, I think he's killing it at 5 a.m.
With Danny Berger.
I'm not here, but you know,
I'm aware of that.
Right at the end.
Lisa is too. You're barely present now.
I get like 5:50, 5:52.
To be fair, neither am I. Still adjusting.
All right.
To a brand new year. Brahma, this was great. Come on, Happy New Year.
Fantastic.
From New York City, equity futures just near session lows. This is Bloomberg.
I'd like to kick off with a very simple question. Has the whole Brexit process been messier, less messy, or as messy as you expected way back in 2016?
Was it as messy as we thought it would be? Probably was, and I tell you why, because of the fundamental mismatch between, if you like, rational policy in the UK and what was, in a sense, performative ideology in the UK. And I think that was the problem. We could have had the deal, the so-called Windsor deal, several years ago, but the Johnson government simply did not want a deal on those terms.
But I think for the short to medium term, the next 3 to 5 years, the Brexit will be net negative on the UK economy, no question about it. What happens over the longer term depends on what the British establishment or the future UK governments do. One, I do think ultimately they will finish up in the next 10 or 15 years putting some kind of, I call it a trade deal with Europe similar to Norway or Switzerland. I disagree with Declan. I think they will pay into a European budget. I think they will have no choice. It is too big. The fundamental strength of the single market is something that is too attractive for the UK economy to be excluded from.
Maybe the messier part is yet to come.
What do you worry most about your economy in Greece? When you look at tourism, it's booming, but it also means some of the islands are overcrowded.
Exactly.
Is there something that you can do about that?
Thank you for asking this question, because I want to make sure that in 5 years from now we will not have sacrificed the beauty of our sort of natural environment at the interest of a very rapid growth. So that's why I'm really focusing on sustainable growth. That's why I will always push for quality over quantity. Very strict in terms of standards. We are actually looking at our local and regional sort of planning legislation across the country to make sure that we know exactly what we can build and where we can build it. There are parts of Greece which have reached saturation point, and if we have to place restrictions, we will, in order to protect, especially islands, which are more sensitive.
From New York City, for our viewers worldwide, I'm Manus Granny, in for Jonathan Farrow. This is the State of Play on markets. It's day 2 of the worst opening across assets since 1999. The countdown to the open, it begins right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Coming up for you today, risk assets extend the new year hangover. Big tech edges lower. That's the consensus after the worst day since October. And traders look ahead to the Fed with payrolls on the deck. We begin with the big issue. What a difference a year makes.
It feels like we're coming into the new year, and now, of course, and we're already seeing the start of a reset, perhaps.
Starting off 2024 with a little bit of a breather.
We're just pausing for breath.
Investors start to take really a sober second look at what the economic environment is going to look like in the year ahead.
We had a very strong rally in the third quarter of last year.
Equity markets have rallied 16% from the low point in October.
Given the rally we've had,
it's an understandable, rational question to be posing at the beginning of the year. Was it overdone?
It's just a really great time to play a little bit of defense.
I don't think that you can have the kind of growth that we've had given the kind of economic backdrop that we're looking at.
The Fed is probably going to be disappointing here relative to the speed at which rate cuts are priced into the market.
We've got some key US data coming up this week.
We will look for confirmation of the inflation and economic data in the next few weeks.
Well, it was fast, it was furious, it was ferocious. Joining me now to break it down and discuss the markets, PIMCO's Aaron Brown, Peter Cheer from Academy Securities. Great to have you both with us. Day 2 of a reflective moment for markets. I want to put this to you. Bank of America's Savita Subramaniam writes this: a right in big tech, a broadening out of the market leadership is becoming consensus. But that means January's pain trade equals higher TMT and mega caps. Do you think it is quite a contrarian position to say that big tech is going to have a brutal day or month of realization? Peter, let's take it to you first of all. Good morning.
Good morning. I always like to be a contrarian, but I find this time of year, we just went through a December where people got forced into the market. People went into the market kicking and screaming. We already saw a bit of a rotation out of big tech into Russell 2000 small caps from November 7th on. I think that continues, but I think it's now going to continue in a down market rather than an uptrending market.
Okay, I suppose it depends what happens to the 493 other stocks. Aaron, let's bring it back to you. We have a renewed gravitational pull. It's sucking us back towards 4%. So for this morning, and perhaps for this month until we see where the Fed comes down, we get some minutes later on in the day, is the gravitational pull just a better re-entry proposition for you?
I think that's right. I mean, if you think about the last really quarter of economic data, we had very benign economic data coupled with a more dovish Fed. And that, I think, really did pull a lot of people into the market, but also back into bonds. I think right now the fundamentals or prices have sort of outstripped the fundamentals. I do think that we'll get there over time, but I think typically January is a month where you see trend reversals. It's also a month, you know, just given the extent of the rally, that you would expect to see a pause after what was a tremendous, you know, sort of monster rally across all global assets. And so I think right now we're really just taking a step back, digesting the data, and we need to see the fundamentals now catch up with the market momentum and prices that we experienced in the fourth quarter of last year.
And that's where the divorce is. I want to get a sense from you. I mean, obviously you can evangelize, Aaron, in that bonds will emerge as the standout asset class. So I'll give that to you, but I want to know why, and in a relative sense, Peter, why should I think that bonds are going to be, it's going to be a great year for bonds relative to equities? Aaron, first of all, stand up the argument on bonds will emerge as the standout asset class, and if so, where on the curve will it stand out?
So firstly, we saw a really significant rally that I think brought forward a lot of the returns that we had expected in 2024 into the latter part of 2023. I wouldn't expect a replay of 2023, at least in the last quarter of last year, to percolate throughout the rest of 2024. That said, I still think that, you know, at, you know, sort of close to 4%, bonds still offer value to long-term fixed income and really global asset owners, given the fact that now we're starting to see them provide more defensive strategy, particularly in downward data or weaker data than expected. You're starting to finally see some of the diversification benefits of fixed income start to pick back up. Secondly, at, you know, about 4% return, that is attractive for a long-term owner with very low risk. And so if you think about that relative to the equity risk that you're taking in a portfolio, you're guaranteed, you know, a pretty good return over the next sort of 5 to 10 years in a fixed income asset. I think then on top of that, you're also getting the benefit of, you know, capital appreciation. And I do think that as we see the data slow from here in the first quarter, you're not only going to get real yield return, but you'll also get capital return. So it's really this sort of trifecta of fixed income that you're getting now, which you haven't gotten, you know, for much of the last several years across fixed income assets.
And a lot of people have put in their notes that we're going to be clip-on couping for the rest of this year and just pick up with an uplift. Peter, let me take it back to you. There's 4% over 10 years. Earnings have got to be pretty stellar to outperform that return. Although you are worried about the consensus. You say that you're torn over the weekend and we've got reckless bullish calls. By nature, I'm not reckless. I'm the middle of the pack. So just how reckless have the calls been on equities? And are you a bit cautious on that?
Yeah, I'm a little bit cautious on everything. One is I think the rates market has got ahead of itself. I think too many rate hikes are priced, or rate cuts are priced in already. So that's going to put some pressure on the front end. And at the back end, it was only a month and a half, 2 months ago, everyone was talking about the deficits in DC, how much interest was going to be part of the budget. No one seems to care about that now. I think that will creep back into the dialogue. So I think yields push a little bit higher, and that's going to weigh on stocks, right? We live in a world where there's pressure on yields. Equities really did phenomenally well. I think people are going to rethink that, especially when you start looking at the market cap of some of these companies. Are these market capitalizations justified? And I think the other story that's going to turn out to be completely, just non-existent is this whole, all this money has to come from money markets. into the equity market. I don't think that's going to happen. I think people are very comfortable in their money market funds. I think a lot of money that had been traditionally held in bank accounts is now in money market accounts, and that's replacing the bank account. So I don't think we have this huge wall of cash on the sidelines waiting to come into the market at all.
Oh, that is heresy. That's heresy compared to what everybody's been telling us. That was supposed to be what will push us through. Listen, let's pause those thoughts for just a moment. Stay with me on the side. We're going to turn our attention to commodities because we've got oil fluctuating this morning. We've got fading optimism about the interest rate cuts. That's challenging cross assets all the way around. But also we have this rising concern about conflict in the Red Sea. Will Kennedy joins us for more. Will, you've just returned from 2-3 weeks in the Middle East. Here we are with quite a surprising ratcheting up of tensions. Iran sends a 30, 40-year-old frigate to the Red Sea, and yet the market seems to assume nothing really to see here, but the risk is there is an accident waiting to happen geopolitically. Good morning.
Hi, Manus. Happy New Year to you. I think that's right. I mean, you look at events around the region today, and there are clear points of tension in the Red Sea and beyond. You have events in Lebanon where the Hamas commander was official was taken out. You have terrorism in Iran itself, and yet oil doesn't get much of a bid from it. I think there are a few reasons for that. One, the market has been living with these risks for several months now and is coping with them. Two, there is a certain amount, a big degree of spare capacity within OPEC coming from the UAE and Saudi Arabia, which dampens the geopolitical premium because when push comes to shove, those countries could put more oil back into the market. But I don't think people should be complacent or dismissive about it. Clearly, there is a huge degree of tension in the world's #1 oil-producing region, and there are any number of ways that could have an impact as we go through 2024.
I was with Bob McNally this morning. You know Amrita very well. Amrita Sen and Bob McNally, both of them, they're well known to both of us. Bob says we're in a funk, and it'll come down to, I suppose, seeing the deficits come into play that have been promised by the OPEC Plus grouping. Do you think that's the thing that can turn this market, Will, briefly?
Yeah, I mean, it's a supply and demand, as always, Manus. I think OPEC will cut. The question about is obviously they plan to cut. How much those barrels translate. I think people do want to see this surplus end. The big question is shale. The thing that really surprised the market last year was just how fast shale grew, much more than almost anyone predicted, 800,000 barrels a day. People are more modest this year, 400,000 barrels. They expect a slowdown. But if it's even faster or it continues to find ways to expand even quicker, that's one factor that can really upset the market in either direction.
Okay, Will, thank you very much. Good context there for the oil and energy market. Aaron Brown, Peter Cheer are my guests this morning. Peter, I come to you. Energy, commodity, it lacks that war premium bid, but you like energy for good and bad reasons. Give me the bid and the offer.
Yeah, so one reason, we're very fortunate at Academy Securities. We have 18 retired generals and admirals who serve as our geopolitical intelligence group. So I feel we're pretty plugged into what's going on. I think the risk of escalation in the Middle East is high. We have been allowing, as a country, Iran to sell far more oil than they should be under sanctions. So that risk of escalation means Iranian oil could come off the market. Except from that, I think I actually like energy stocks much better than energy itself. So I think we're going to see growth. And so we just kind of went through the bad reasons, which is geopolitical. I think the good reasons are there's a shift in the ESG mentality and how people are thinking about sustainability. And I'm seeing a real progress towards a 10 and 20-year plan where there's a realization we are not going to be sustainable only in a year, 2 years, 3 years, whatever kind of people dreamt of. We are going to have ICE vehicles for a long time. We're going to need energy. And I think that's going to fuel a lot of growth, no pun intended, for the energy companies. And I stick to this mantra, which I've been using for 3 or 4 years, is that the energy companies of the future are actually the big energy companies of today. So I really like them better than the commodities themselves.
Yeah, big energy just reincarnated. Let's put it back across to Aaron. Look, to a certain extent, the standout asset of choice for you is going to be bonds. Part of that is going to be the disinflation narrative. And second to that, I want to get a sense from you, to what extent does a geopolitical risk play into the bid for bonds as a backstop or as a portion of hedge, let's say?
So I think that's right. I mean, I think over the last 2 years, you haven't really received much of a hedge from global fixed income assets, just given the inflation picture was quite, detrimental to fixed income as an asset class and certainly as a hedge. That now has turned. You now see the tables shifted. Inflation projections are likely to continue to show that inflation is going to move lower throughout the course of this year. And you can start to see fixed income really perform like it has in the past as a diversifier and as a hedge for the global assets that you hold in your portfolio. And so I think now for the first time, you know, in at least 2 years that we can credibly say that fixed income is back as a defensive asset and as a hedge to your portfolio. And that's one of the reasons that we, you know, do think that there's real value to fixed income now in portfolio construction.
Well, now to be fair, it took a bit of time for the old bond market to waken up to being the hedge of hedges last year, and it didn't exactly perform very well for us in the front 8 months. But let's see, we've got a long road to run, and of course we have an election at the back end of the year. We didn't get there. I'm sure you will get to that with Jonathan in due course over the next couple of weeks. Aaron Brown, Peter Cheer, thank you for being there, and they are going to stick around. We've got more work to do on the Fed. Joining us now to look at the movers ahead of this opening bell, Abigail Doolittle is side by side with me. Abby.
Well, Manus, there is overall a bearish tone. We're looking at the S&P 500 and the NASDAQ heading to a potential 4th down day in a row for the worst loss since the end of October. Over that time period, not surprisingly, weighing some of last year's big winners. In fact, NVIDIA, the biggest winner of last year, up more than 240%. The chip maker now heading to a 2nd down day in a row. Consolidations, investors getting a little more defensive. The SOX, in fact, that chip index technically looks very vulnerable, so it may turn into a little bit more of a pullback, but we'll see. Coinbase reversing the big gain recently, down today, this morning in the pre-market, down 7.5%. This is, there's some speculation that the SEC may not be as fast to approve Bitcoin ETFs as had been previously thought. Plus, with the risk-off tone, investors heading out of Bitcoin. And then finally, Disney down just slightly. And of course, this board battle intensifies as both ValueAct and Blackwells make moves that align them with CEO Bob Iger versus Trion's Nelson Peltz trying to make a move onto that board. More on that on the open, Manus.
Okay, let's see how they react and how Apple behaves at the open as well. Coming up, the IMF is expecting the Fed to secure a soft landing.
People should be feeling good about the economy. The inflation moderating already and continuing to moderate is due to the decisiveness of the Fed to increase interest rates.
Traders gearing up for the Fed minutes, along with a host of economic data this week. That conversation up next. This is Bloomberg.
What did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way: know your why. You have to know why you're doing this, because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about, so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
should be feeling good about the economy because they finally would see relief in terms of prices. The inflation moderating already and continuing to moderate is due to the decisiveness of the Fed to increase interest rates. And while that has been painful, especially for small businesses, it has brought the desired impact without pushing the economy into recession.
The IMS, Georgieva, they're saying the Fed has achieved a soft landing. The FOMC's December minutes are right later today. Jay Powell admitting that the meeting officials had discussed rate cuts. Since then, some officials have pushed back on that dovish pivot, but there's more data on the deck this week, including the jobless claims ahead of the December payrolls. We got JOLTS today. Also set to show that Powell is right about whether inflation can slow without impacting the labor market. Mike McKee is with us now. Will something change between December the 1st and December the 13th? Mike McKee, tell us, what's the data going to show us today and tomorrow and Friday?
Well, everybody's looking forward, man, as to seeing what the minutes say and whether there's any kind of real pushback in there to the idea that the markets took away from the meeting in December, that the Fed's going to be cutting rates a lot. Tom Barkin, the Richmond Fed president, with some warnings that you need to take this in context, that there are 19 different people who make their forecasts, and that it's only in that context in which the forecasts are right and inflation does, in fact, continue to settle, that they forecast rate normalization to begin sometime this year. He points out that the rate forecast range of estimates was pretty wide. And he says, I would caution you to focus less on the rate path and more on the flight path. Is inflation continuing its descent, and is the broader economy continuing to fly smoothly? Well, as you mentioned, Menace, we get some data that will give us some ideas about what the context of all this is. We get the jobs report on Friday. 170,000 is the forecast. 3.8% unemployment, not really going to tell you that things have slowed down a lot. Then we get, of course, CPI next week. That's going to get a lot of focus in the markets. We should see some base effects there that maybe even push it up a little. December retail sales, and then fourth quarter GDP, which looks to come in about 2%, not a slowdown of any significance. And then December PCE, the Fed's numbers, and then we have that meeting at the end of December, and we'll see what they tell us then about what happens next. Today we also get, as you mentioned, the JOLTS report and ISM, and ISM is supposed to go down a little bit, but these are the numbers that Wall Street's really going to watch, the sub-indexes that tell us something about the prices paid, employment, and new orders to see which way the factories are leaning. And they've been going up, and they're expected to sort of level off, but watch that prices paid. It went up to 49.9 last time. The forecast is for it to come down to 49.5, but if it doesn't, that could be a wrench in this story that the Fed is going to be cutting a lot.
Well, it could help reawaken the odd bond vigilante. There's a risk for you. Mike, thank you very much. Mike McKee, setting the agenda for the data over the next 3 days, and today, critically important on that agenda. The talk of last month's Fed meeting was Chair Powell's pivot. He started the month saying this: it would be premature to conclude that the confidence we have achieved a sufficiently restrictive stance or to speculate on when policy might ease, then pivot. 13th December, Powell mentions cuts post the decision, saying, quote, that begins to come into view, and clearly a topic of discussion out in the world, and also a discussion for us at our meeting today. So are they going to achieve a 1995 soft landing? The lady with the answer to that is Erin Bryan. Is that your core belief, Erin?
So I think that whether they achieve a soft landing or a slowdown into a softer landing is probably the question to ask. And we're not expecting by any means a hard recession. We do think that there's going to be softness throughout this year with declining inflation. So if that's what you define as a soft landing, I don't think we're going to be off to the races with respect to growth. And this is a new sort of inflection point for more positive growth. I do think it's going to be a more challenged year for growth this year, but we'll likely avoid, sort of the left tail of a hard recession. in that environment, asset classes can do well, but I would say that they'll do well in not a linear straight line, but also in a more measured or more moderate pace than what we experienced certainly from last year. So, you know, I think that this is an environment where all eyes today are going to be on the Fed, where they're really going to be looking for insights and clarification with respect to, you know, what those minutes are suggesting, not just for the pace of rate hikes, but when it's likely to start. The market's already underwritten a pretty aggressive rate cutting cycle. And so that's, I think, going to be the key point to look at later today.
Peter, in terms of extending risk and taking risk, what do you need to hear in 30 seconds?
I really need to see the economy chug along. I think we need to see decent job numbers. We need to see consumer spending continue. I think that's where the risk is. If the consumer slows down into this geopolitical tension and the Fed kind of pushes back a little bit, I think that's where we get this risk off trade. We get yields go a little bit higher, and we could see the S&P pull back below 4,500. So that's what I'm thinking, and I need something to change my view, and I'm not seeing that yet this year.
Okay, 47.63 is where we are on the futures. Unconvinced. Peter Cheer, Aaron Brown. Let's see what the Fed minutes have to say and the data. Coming up over the next 37 minutes. The morning cools. We got Hightower's Patrick Frizzettia. He joins me with his outlook for the year ahead. All that conversation to come right here on Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He was a day trader. He taught himself, self-made day trader.
Yeah.
And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
Time for your morning calls. Let's see what the analysts are describing this morning. First up, KeyBank upgrading Verizon to overweight, expecting insurers to benefit from favorable setup and easing competition. Mizuho downgrades Exxon to neutral, seeing limited upside on commodity prices. Where's the commodity supercycle gone? Finally, Wealth Research upgrades Citigroup to outperform. They're not the only ones, pointing to numerous tailwinds and the stock's compelling valuation. Coming up, we'll talk about those stocks and the mood in the markets with Hightower's Patrick Frizzettia. He joins me very shortly, bull or bear, on day 2 of this global market reflection on Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
In London, in Sydney, from Washington, in Tokyo.
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Countdown to the Open. I'm Manus Cranny, in for Jonathan Farrow this morning. We're just waiting for the cash trading to start. You had the worst start to the year for across the assets since 1999. Nasdaq was down 1.7% yesterday. You're looking at a pretty brutal moment of reflection. By the way, the flow of money into these equity markets, $19 billion went into these markets through to the close of business on the 27th. For the flow is there. The question is, there is a lack of conviction in this morning's first trades. It's day two of a pretty tortured opening, the worst since 1999. In terms of the rest of the assets, you can see here the debate is whether it's going to be risk or rates that define the trajectory for the dollar. We had Rabobank with me this morning saying that Jane Foley has some sympathy for parity in terms of the euro because that Europe is so challenged at the moment, and the ECB will probably be outcutting the Federal Reserve. 10-year yields pop a little bit higher. The gravitational force, as Katie Greifield crescented last week, is heading towards 4%. What would that do to the technology trade? And crude is still mispricing war premium to the extent of around $12, according to Rapid Energy, even though it bounces by nearly 2% on those rising escalation and threats between Israel and Lebanon. We're waiting for some confirmations there. There are opening trades and timestamps to be had. Apple is on the block, the tech giant extending its decline for a third session after leading the way lower on Tuesday. Ed Ludlow joins me with more. What happened to the $4 trillion valuation that we were told about last week? Ed Ludlow, why oh why the shaking shivers in Apple? Good morning.
Good morning. Well, there's a narrative that's building of the Magnificent Seven we talked about so much in 2023. Apple perhaps is the least magnificent of the lot. We're down another 0.5 percentage point. As you said, a third straight day of declines. It follows Tuesday's session where Apple had a decline of 3.6%, its biggest drop since the end of September. The catalyst being that downgrade from Barclays, a change in price target to $160 a share, just a $1 trim, but moving Apple to underweight. Their thesis is basically that the stock defied gravity in 2023, right? You had several quarters where earnings missed expectations, and yet the stock grows 50% on the year to a record, a $3 trillion market cap. They don't see that lasting. Their analysis is based at looking at the volume and mix of iPhone 15, the latest generation iPhone, having concerns, and then looking ahead to the iPhone 16 and saying, we don't feel there's enough on the technology cycle, technology upgrade trade perspective to keep driving this stock forward. We care as well because it had an impact on markets, right? This was the biggest drop for Apple since the end of September, but it also pushed the NASDAQ 100 to its biggest one-day drop since the end of October. Biggest points decliner on both the S&P 500 and the NASDAQ 100. So that will be the story for 2024, right? How magnificent will Apple be? Will it defy gravity as it did in 2023? And what will be the catalyst to drive growth? If not iPhone, some other category, be it services or another device.
You know what they say, Ed? Smile on the way up, but I don't think anybody's calling time on Apple just yet. Ed Ludler there on the Apple moves. We're also keeping an eye on Disney. You got Blackwell's Capital will nominate 3 directors at the entertainment giant to preserve Bob Iger's vision. Abigail Doolittle has the latest on that. Preserve or shake up? That's what goes through my mind. Abby, good day.
Well, good day and good morning. And I think that this overall is a board battle that is intensifying because we, of course, have had Trion's Nelson Peltz in the mix for quite some time. But today we do have 2 firms, ValueAct and Blackwell's, essentially saying that they are going to enter the fray on the side of Disney and Bob Iger, well ahead of the company's annual meeting that typically occurs in March or April. Now, to set the stage again, Nelson Peltz's hedge fund, Trion Partners, they plan to nominate 2 candidates to Disney's board this year. They have a roughly $3 billion stake, intensifying their roughly year-long campaign against Disney for change, saying that the board is too cozy to CEO Bob Iger and that they are disconnected with shareholder interest. Now, this morning, ValueAct saying it will support the Disney board's recommendation. They also have a confidentiality agreement where it sounds as though there could be some information being exchanged there, some advice being provided. Then Blackwell's, as you mentioned, entering the fray, nominating 3 people to the board and vowing to preserve Disney's Iger's vision. Not only that, they're also demanding that Peltz immediately end his campaign for change. What makes all of this interesting, Manus, of course, is the fact that the stock down more than 20% from last year's peak. This is a situation that could continue to develop ahead of that annual meeting this spring, where shareholders will, in fact, get to vote. And it's going to be interesting to see who they will be voting on at that time.
Yeah, well, they want a higher stock price, and that involves change. Abby, thank you very much. Abigail Doolittle. Sticking with the boardroom, we've got Bloomin' Brands. They're naming 2 directors. It's new cooperation agreement with Starboard Value. What are the details? Simone Foxman is with me. Simone, what have we got?
Yeah, Manus, I don't know if you've been to these restaurants yet. Outback Steakhouse, Bonefish Grill, that is Bloomin' Brands. These 2 new board members are part of an agreement with Starboard Value. One is from Starboard Value, John Sagal. The other, Dave George, had been the COO of Darden Restaurants. Starboard now owns about 9.7% of the company's common stock. That was originally disclosed back in August. The company also said that it's going to form an operating committee. Those 2 new board members, as well as 2 current board of directors members, to look for ways that it can improve the brand. Starboard Value, really known for its successful proxy fight with Darden Brands. That got a bit combative a couple years ago, back in 2024, and it eventually resulted in Starboard taking full control of the board. So far, we're not seeing that same sort of relationship between Starboard Value and the brand here. In fact, Jeff Smith, the CEO of Starboard Value, saying that Bloomin' Brands had been collaborative and open dialogue so far. But this news causing Raymond James to raise its price target to $30 a share. The company's shares are already up 39% since last year. They were up 39% last year, I should say. They were up roughly 10% since Starboard Value announced was reported to have taken its stake back in August, but they're still about 10% below hitting their April 2021 high, and we're seeing a little bit of a pop this morning, Matt.
Yeah, the thought that goes through the mind is where they're going to trim the fat on the steak on that, excuse the pun. I like the look of Fleming's. Looks very, very regal, very reminiscent of a British eatery. And Bonefish Grill, I'm all in on that. Simone, thank you very much. Simone Foxman with the very latest in the boardroom battle. Let's turn our attention to crypto. Coinbase leads the sector lower. Speculation, I get this. Spot Bitcoin approval, there you go. Katie Greifeld. I mean, this has got a bit of a shakedown. ETFs, we were talking about them last week. What happened? What's gone wrong? Why?
Well, right now you're watching Coinbase, Marathon, Riot, all taking a bath right now alongside a plunge in Bitcoin. That plunge as much as 9% this morning, briefly breaking below $41,000 per coin. And as you mentioned, Manus, speculation around a potential spot U.S. Bitcoin ETF finally launching. It's at a fever pitch right now. So to set the stage here, the SEC has a deadline coming up next week to take action on one of the dozen or so applications in their queue right now. And the current thinking is that they'll either approve or reject all the applicants at once rather than playing kingmaker here. So as you would expect, rumor, innuendo, it's at an all-time high right now. That's translating into volatility, both in Bitcoin itself and those crypto-related stocks. But it's important to note that all of these assets, all of these names, they're coming off a banner 2023. Take a look at Coinbase. It surged nearly 400% last year alone. So what you're seeing could be as simple as people selling the rumors, selling the news, choosing to take profits here rather than waiting around.
Okay, Katie, let's keep an eye on that. The ever-giving story of the ETF. Patrick Frizzetti is with Rose Advisors. He's weighing in on the new year. This is what he says. The market appears overly optimistic, as I do not think we are out of the woods on inflation. The genie is not going back in the bottle without a cost. Patrick joins me now. I'm focused on the cost, which implies higher for longer or the Fed is not done. Good morning. Be the contrarian for once.
Yeah, I'll be a contrarian. You know, I think 2023 was a year well explained by, you know, first it started out with a banking crisis. The Magnificent Seven outperformed until rates peaked, right? Rates peaked in late October. Then you started to see the equal-weighted S&P stocks outperform those tech stocks. And I think, you know, when you think about as, you know, lower rates and the Fed lowering rates started to price into the market, you know, there's two expectations. Two things really, you know, justify lower bond yields. And that is inflation's going back to 2%, or something else worse is happening, like we're going into recession. And I think it's very unlikely that inflation gets back to 2% anytime soon.
Well, that's going to take some kind of a spike in unemployment to really contain the last mile, the last leg, the last 1%. You say that this is an opportunity for equities to rebalance. This is an opportunity for me to rebalance. So where do I rebalance out and into?
Yeah, look, I look back to, you know, the prior year, 2022, you look at what helped, what was defensive in 2022 when the market was down a lot, and then what underperformed in 23. Look at things like energy, look at materials, even the healthcare sector overall. I mean, think about pharmaceuticals in an election year. Pharmaceuticals won't be on the hit list in an election year, which it typically is. And I think I look to those sectors to potentially outperform this year.
You're not convinced, by the way, that the money market funds flow as munificently as other people think. I've already had people kick back against that this morning. Why do you think the money sticks in money market funds for longer than we presume? That's what I'm thinking, which is why would I give up 5.3% to take equity risk if there's already a shakedown at the moment?
Yeah, you won't. You won't. I mean, if you were giving up all those gains and you weren't chasing the momentum of 2023 and you were sticking with, you know, 5.5%, 5.25% money market funds, you're not going to go into, you know, these high priced or, you know, high multiple stocks right now. It's not going to become a risk on trade. I think they'll stay where they are, or maybe they move some of the money into bonds or extend some duration or something along those lines. But I can't see adding on significant risk if they've been sitting out much of the momentum in 23.
Okay, well, maybe it just takes a chunky cut from the Fed in the first instance rather than that sort of slow drift of 25 bips at a time to shift the money out of money market funds. Patrick, stay with me. Patrick Frizzetti, my guest on the markets. Coming up, Mike Mayo doubles down on the bullish call for Citigroup.
I understand Citigroup's mistakes, but what's different this time is the result of this restructuring should be a much more simple Citigroup, not a more complex Citigroup, and that's night and day.
The recent rally in banks sending JP Morgan to fresh record highs. Where are they winning? We'll break down the financials. That's next, right here on Bloomberg.
trend emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
We had some pretty tough talk.
bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report tonight at 9:30 Eastern. Bloomberg, context changes everything.
The annual prize money pool in LPGA tournaments has grown 50% since 2019. In 2023, it topped $100 million. But the prize fund still lags far behind what men compete for on the PGA Tour. The inequality hits hardest at the lower end of the money list.
Clearly, we want the top players to continue to make a great living playing. These are the very best in the world. But we also then dig in and say, okay, what's the 50th best player in the world making, and what did she make last year? I've asked Kathy to run numbers many times to say, okay, tell me where we are exactly during the middle of the season, at the end of the season.
That 100th player, our goal would be to obviously have that player make considerable amount of prize winnings, and we're going to work really hard to do that. Having said that, we do need to continue to focus on ways to provide opportunities so that 100th best player can cover those costs that it takes for them to be out here on the golf course. That's hiring a caddy, that's travel, that's strength coaches. We're helping to provide stipends for health insurance or create a tour-wide health insurance program. Ability to create more discounts for travel, for hotel and car and all those things that really cost them a lot.
To meet these objectives, LPGA leadership collaborates creatively with sponsors.
We've worked with some of our corporate partners to say, help us solve a problem. Help us create a fund that will allow our players to get to the first tee ready to reach peak performance.
My top three picks for 2024 are Citigroup, Citigroup, and Citigroup. I think the bottom line is that Citigroup is becoming a much more simple and profitable firm whose earnings should double over the next 3 years. But this is make or break time for Jane Fraser. You said, is this due to Jane Fraser? Maybe. I think so.
Yeah.
But not definitely. I understand Citigroup's mistakes, but what's different this time is the result of this restructuring should be a much more simple Citigroup, not a more complex Citigroup, and that's night and day.
Wells Fargo, Mike Mayo, doubling down on his bullish call on Citigroup, but not necessarily on Jane Fraser. Now, the bank superseded JP Morgan as his top-rated big bank stock for 2024. The analysts expecting shares to more than double over the next 3 years. Alison Williams joins me now from Princeton. Alison, good to have you with us. It's an interesting nuance, isn't it? I'm bidding up Citi, I'm putting them up on the stack, but I'm not convinced it's all to do with Jane Fraser. But this entire restructuring, I'm understanding, is Jane Fraser.
I think Jane Fraser is the difference this time. I think for an investor to buy Citigroup, they have to believe that this is the time the restructuring works. And let's be clear, the valuation of Citigroup, it's traded at a discount to book for a long period of time. And I think that reflects doubt. This is a stock that, for decades, many investors, many sell-side analysts have said, look, there's a lot of opportunity here. This is a company with a lot of great businesses. If they can just, improve their efficiency, get their act together, shed some unprofitable businesses, it should be a great stock. Unfortunately, many of those calls have been disappointed. And so it's been many, many years of trying to reach a target and not being able to reach that target. So the medium target for Citigroup now is 11 to 12%. The cost ratio to get there is something that they're still way far away from. And so the question is, can they get it done? Jane Fraser has made some tough decisions, exiting businesses that the bank has been committed to forever. Yeah. And I think two things. One is Jane Fraser, but two is, I think one of the best things that's happened to Citigroup is the regulatory scrutiny that has forced a lot of the transformation and has forced them to improve the risk systems, forced them to do a lot of the spending that perhaps they should have done decades ago to bring together all the disparate businesses that were purchased and brought together under one umbrella, but not necessarily integrated in an efficient way.
Well, that takes us back to November when Jane Fraser shuttered her business. They were so committed to the Muni business. It was like inextricably linked. Alison, thank you very much on the banks. Let's turn our attention to JP Morgan, soaring to record highs for the first time in over 2 years. Though CEO Jamie Dimon has warned the bank is over-earning in some areas. What does he mean by that? Abby?
Well, their tremendous profit last year, they just did a tremendous performance. And what's so interesting here, Manus, is that, of course, JP Morgan is considered to be the best in class, in large part because of CEO Jamie Dimon. Now, the stock may be down just a little bit today, but yesterday, to your point, they did put in a record high, the first one in more than 4 years. And if we take a look at JP Morgan last year, that over-earning that you were just talking about, referenced by CEO Jamie Dimon, the stock up 27%, the best year since 2019. This as the KBW Bank Index, or the benchmark, down 5%. So some clear outperformance. Investors flocking to Jamie Dimon's best-in-class, largest bank in the wake of the collapse of those regional banks in early 2023. Plus, they benefited from the acquisition of failed bank First Republic from FDIC. In fact, we had a clip earlier of Mike Mayo, Wells Fargo analyst. I'm not sure if this was from yesterday, but he did say of JP Morgan, Goliath is really, really winning.
There you go. You haven't got a JP or an M in it. You're not in it. Abigail Doolittle there. Let's turn back to my guest, Patrick Frusetti. Patrick, would you be long banks? Is there anything that could convince you to be long a bank in the United States of America?
Not at the moment, to be quite honest with you.
Why?
Because look, we're what, 10 months out of a banking crisis, and we still haven't seen, I think, the worst of the commercial loan issues and defaults. We don't know where the bodies are buried, so to speak. And you have these large bank balance sheets there. You were talking about Citigroup, and this is what the big banks do. They restructure, every once in a while, then they try to get back on track. And I think the commercial loan issues that banks are going to have to face, could create a lot of problems. There was a new Fed paper out that basically did some sensitivity analysis and talked about, just a 10% move down, what that would mean to Tier 1 capital. And if you see a 20% move down, you'll see a big impact to Tier 1 capital of the large banks. And that's the thing why I think there's just better things to buy out there, and I've avoided the banking sector. It's not to say I've always hated banks. It's just to say at the current moment, given what could potentially be, I think, a crisis, and many have thought it. They've just been waiting it out. Well, when is the cliff going to come? When is the cliff going to come? And I think it's eventually, until I have some more information on that, on that data, it's very hard for me to invest in banks.
No, listen, I know once bitten, twice shy on some of these banks, and certainly last March, nobody saw that truck coming to roll over the top of us. In terms of 2024, do you want to be? I know that you want to be longer, slightly more defensive plays, but is that something slightly more, dare I say it, boring? I mean, if I said you Novo Nordisk was going to be a boring stock in Europe, you probably laugh at me. But here we are. Pharma is very much a big play, isn't it, in terms of the weight loss drugs and in terms of cancer treatments? Where do you want to be, if not in financial?
Yeah, I mean, I like healthcare. I like the pharmaceutical space. I really like materials. I mean, if we're going to have a weaker dollar, I mean, if rates are going to go down, if the Fed is going to cut, which I'm not a believer that they're getting, the market may be pricing in too many cuts, I think, at the moment. But if the dollar's weaker, you want to own materials, you want to own energy. And like I said earlier, this might be the first election year where pharmaceuticals are not, at the top of the hit list for, one of the political parties.
You mentioned election very briefly.
Yeah.
Literally in 30 seconds. Do you think this market will back up and front run that election in 30 seconds? Do you think we'll see a real action in September and then quiet?
It really depends how close the race is. If the race is close, you could see that, and then post-election, the market tends to rally because markets don't like uncertainty, and then when they get, they find out who the victor is, assuming we do, the market tends to rally into the end of the year. Simply.
That's why we pay commission to people like you. You're supposed to be smarter than us and have the answers to that. Patrick, I'll leave you with that nervous twitch for the rest of 2024. Patrick Frizzetti. Coming up on the show, market moving events that you need to keep an eye out for your trading diary. We'll break them down for you from manufacturing to jobs right here on The Open. This has been
Did art conservation help you in any way to be a better investor? And should a lot of good investors learn how to be an art conservator as well, or not?
I think in conservation and art history and liberal arts, I think differently than a lot of people that have just done finance. And also, I think I mentioned one of the things is to do conservation, you have to really do a lot of pre-work before you actually do a treatment. And so a lot of that pre-work is very similar to what I do in due diligence for investments. Lots of testing, lots of thinking about what could go wrong, lots of research. When I was an art historian, that was in the old days before the internet, but you'd sit in the stacks and you'd pull one thing in a bibliography on this and you'd sort of like a mosaic theory, put all these things together. I feel like I do that in my due diligence.
Time now for your trading diary in terms of what we're watching. By the way, all that argument about a breadth in market, yeah, that's history, down 1.5% on the Russell there. You're also seeing the rest of the markets take a little bit of a breather ahead of some of the data that we've got. The ISM manufacturing numbers and the JOLTS data, they will hit the tape at the top of the hour, so just under 4 minutes away. Following that, it really is the nuances of the minutes. Will they confirm and validate the Powell pivot? That is at 2 p.m. Eastern Time. Thursday, you got the jobless claims. That is the curtain raiser to the main event. You thought you had Christmas Day and Thanksgiving. No, it is the jobs report for December. Let's see what the payrolls number give us there. Is pretty important. Okay, stocks and bonds are having the worst start to the year since 1999. Where were you in 1999? Countdown to the open for this morning.
what did you learn in the last 40 years about leadership in politics?
Well, I've been learning a lot about leadership for a very long time, observing it in others, recognizing what is needed to get the job done. And I always define it in this way. Know your why. You have to know why you're doing this because you will be under attack, this for sure. Know your why, know what you're talking about, know how to get it done, think in a strategic way, and then that's all up here. And then also connect directly with people. If you can show them how important what you're advocating is and what you know you're talking about so they trust your judgment, and you have a plan, you will have followers. You will be a leader.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions. This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong? Isn't this a slam dunk time to buy U.S. Treasuries?
Soft landing, hard landing, no landing. I don't know.
True. What the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
Good Wednesday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Coming up, we're going to talk a little technology with Anurag Rana. He covers all things tech for Bloomberg Intelligence. Talk to him about what's happening in 2024 for big tech. Is it still all AI? I want to talk a little bit about Apple. We got a downgrade yesterday. Sally Bakewell, U.S. finance team leader, is going to join us. We're going to talk some big banks, big investment banks, Morgan Stanley, J.P. Morgan. We have an interview with James Gorman. Shonali Basak is going to have that with Morgan Stanley outgoing CEO, so that'll be cool. So we'll preview that. And then Michael McKee, he covers all the economics for Bloomberg Radio and television. We got Fed Minutes today. I don't pay attention to Fed Minutes, but Michael McKee does, so he's going to tell us kind of what to look out for. So we got all that coming up in this hour. But first, let's get a Bloomberg Business Flash. Nathan Hager down in D.C.
Well, Paul, we're paying attention to the latest economic data. We just got December ISM Manufacturing Index came in a little bit better than expected, 47.4 compared to a Bloomberg Economist estimate of 47.1. The level is the highest since September for ISM Manufacturing, and JOLTS job openings came in a little bit weaker than expected in November at 8.79 million. The estimate from economists surveyed by Bloomberg was 8.821 million. Stocks continue to move lower as we await those Fed minutes later on this afternoon. Cameron Dawson, Chief Investment Officer at New Edge Wealth, says in this market, investors need to be nimble. She says the biggest risk is that rate cut expectations get repriced.
The pain trade is that everybody thinks that inflation is fully vanquished and then gets surprised if things like oil prices move higher, wages end up being stickier than expected, rates move higher, and then all of those stocks that re-rated in the last 2 months up 30, 40% because now they're not worried about their balance sheets anymore. Balance sheet risk becomes an issue again, and you get a reversion of a lot of the names that were lower quality that happened to lead at the end of last year.
And you can hear more from Cameron Dawson of New Edge on the Bloomberg Surveillance podcast. As for this market, the sell-off continues with the S&P 500 down 22 points, or about 0.5%. 4720 is the S&P level. The Dow Jones Industrial Average is down 165 points, 0.4% lower at 37,549. The NASDAQ Composite is down 0.6%, down 85 points, trading at 14,680. The 10-year Treasury paring some of its losses now, down 8/32 for a yield moving down to 3.95%. The 2-year is at 4.32%. NYMEX crude is moving up 2.9% now, up $2.02, $72.40 per barrel. COMEX gold is down about 1%, or $19.50 at $2,053.50 per ounce. The euro, 1.0932 against the dollar. British pound, 1.2649. The yen is at 142.99. That's a Bloomberg Business Flash, Paul.
All right, Nathan Hager, thank you so much. We appreciate it. Paul Sweeney live here in the Bloomberg Interactive Brokers studio. We're streaming live on YouTube. So head over to youtube.com and search Bloomberg Radio, and that is where you will find us, as Nathan was just reporting. Red on the screen here for day 2 of 2024, trading the S&P off about 0.4%, extending the losses from yesterday. Let's see where the action is under the hood. Carmen Reineke joins us. She covers all the equities for Bloomberg News. Carmen, what are you looking at?
Yeah, Happy New Year, Paul. So what I'm looking at this morning, we're looking at a lot of crypto-linked stocks. First of all, I'm going to talk about Coinbase, ticker COIN. So Bitcoin is down about 6% right now, and that's affected all of these miners and different platforms. So Coinbase down about 3%. TeraWulf is down 6.5%. That's ticker WULF. And Marathon Digital, ticker MARA, also down about 4.5% right now. This is some early year volatility that we're seeing in the price of Bitcoin. It also is coming as traders are weighing the possibility of a spot ETF being approved. Yep. That was something that they were looking for in January. I think the timelines on these things always are kind of up in the air, right? So we'll see what happens going forward there. But
there has to be a decision by next Tuesday, January 10th, and the expectation was, I guess the consensus call was, it's likely to happen, but not super likely to happen. There's enough uncertainty out there that you're not sure which way the SEC will go.
Right, and so until I think we actually get the news there, people are, maybe saying, okay, maybe now's the time to take some of these gains. Obviously, crypto had a huge run up last year. Coinbase was up, more than 300% at one point for the year. So it might just be a good time to say, all right, we'll sell a little bit going into this news. Other stocks that we're looking at this morning, SoFi Technologies, ticker SOFI, down more than 11% right now after getting a sell equivalent rating from KB analyst Michael Perito. This comes after a really large rally in 2023. Shares more than doubled, and Perito said that this really took the stock's valuation to premium levels. So, also recommending, just trimming some of your holdings. If you're a SoFi investor. He also cut his price target a little bit, just to $650 from $750. Another one that we're looking at.
That's another. We had Apple downgrade yesterday from I guess Barclays.
Yep.
This downgrade from KB. Now KB is a Keefe Bruyette Woods, which is one of 2 or 3 of the top investment banks that really focuses on regional banks. So when these analysts make a call on a financial stock like SoFi, the market really pays attention because these are the firms that really focus on regional banking in particular. So they're experts.
Yeah, no, you're definitely right. That's the index that we're always tracking for those regional banks, the KBW index. And you mentioned Apple. That's also one that we're looking at today. It's down for a second day in a row, about 0.5%. I think investors are still reacting to this downgrade from Barclays. I think the other thing is, we're seeing some of the Magnificent Seven decline in the first few days of the year. Again, people trying to take those gains after a really, magnificent run in 2023. I was also looking at Apple analyst ratings, and it looks like this is actually the most sell equivalent ratings it's had since about 2020, which I think is kind of interesting. And it's not a huge move, but the thing about Apple, it's so big that even these small moves are, billions and billions of dollars. Right now I think it's more than 17 billion erased by, less than a % move
and,
down.
the market cap today of $2.9 trillion, and just looking at the stock for the first couple of days of the year, off about 4%. But when you look at it on a trailing 12 basis, the stock's still up close to 50%.
Exactly.
So for a company with that kind of market cap to see that kind of move, shareholders made a lot of money over the last 12 months with Apple. Great stuff, Carmen Reinecke. Thanks so much for joining us here in our Bloomberg Interactive Broker Studio. Carmen covers all the equities for Bloomberg News, giving us a little taste of what's happening out there with some of these names. Again, kind of the big story here, I think just looking at my screen is, again, Bitcoin off 6%, 42,400, and that's taken down, as Carmen mentioned, a lot of those crypto-related stocks. Let's talk big tech. And when we talk big tech, we talk to big Anurag Rana. He is Bloomberg Intelligence Senior Technology Analyst. And Anurag, I kind of liked the Barclays call yesterday because nothing was happening, and he had the stage all to himself. But what do you make of the Apple story here as we talk about 2024? Because again, stock was up about close to 50% last year. What's your view of Apple here as we start 24?
Yeah, Paul, if you see, over the last 12 months, nothing really major has changed in terms of fundamentals of Apple. And we've only seen, I would say, a little bit of bad news come out one after the other. And after the last earnings, season, when we knew China wasn't going to be as strong, I think it's pretty much done that this year they're not going to see, anywhere close to the high single-digit sales growth that people have been used to over the last several years. I think this is really the big story for Apple is the growth is not there, and why pay a high multiple? And that's the discussion you and I have been having for almost 12 months now. Last year, I think it was kind of a safety trade. Now, at this point, if the economy is not going to go into a recession, I have a feeling people are going out of the big safety stocks into some of the more growthier or riskier names.
So how does Apple, I guess from a stock perspective, when you talk to investor relations people, how do they position the company, the stock here? Because you're right, I am looking at the FA function on Bloomberg, and the street's kind of looking for, kind of low to mid single digit revenue growth for the next couple of years, high single digit EPS growth. How do they kind of justify the multiple, or how do they position it?
I think they, talk a lot about the ecosystem. They talk a lot about that this is the installed base that is not going to be eroding anytime soon. And in fact, it has a very high level of customer loyalty. So the big question is, do people leave Apple and go somewhere else? And that's highly unlikely. But I think the biggest issue in our view, at least for the next two years, is, what's going to happen in China? Because it's really the growth engine for Apple. And if they are losing market share to Huawei's new phone, and if that continues throughout the year, then I think they will have a very muted 2025 also. And I think that's really the big story for Apple right now is really what's happening in China. Everything else you can pretty much throw it out of the window.
All right, so let's it's a big part of their sales, and it's also a big part of their cost of goods sold, where they, source this stuff, their supply chain. How should we think about China? What's the company saying as to kind of their strategy there?
So during the last earnings call, they were very bullish on China in terms of the iPhone, because that's the biggest question is, are they going to lose out to the local brand over there? They were very bullish about it in their comments. I think the upcoming earnings season, over the next 1 month, when we hear Apple talk about their results in China, it's really going to show whether the iPhone is holding up or not. The weakness in China, they really cited it to Macs and, iPads. And now that's more of a seasonal, or I would say more of a, stuff that goes up in one quarter and comes down in the another quarter. But the iPhone is really the big story in our view. Now, the reason why China is important is, even though India is another area where you can see in terms of the population growth, China is a lot more affluent than India in terms of the purchasing power. So when you have a very low market share in China, let's say less than 20% of units sold in China are iOS driven, they have a long way to go before they reach maturity. So any problems in China really, hampers their ability to grow.
Do we have any evidence that there's a Chinese consumer backlash against U.S. products, namely Apple products, and that I'm going to, turn in my Apple phone and get a Huawei phone because I'm not happy with what's going on there?
So, Paul, I don't think it's the case with Huawei phone is that their first big upgrade after several years. So if let's say you were a Huawei user before, you really didn't have that next phone that came in. I think that's really what's driving the refresh cycle. There is a consumer slowdown in China, and I think it's hurting all premium brands, including Apple. Now, in this case, I would have expected last year Apple sales in China to be a little bit better than they have been. But as I said, I think the next earnings season will dictate what kind of guidance they put out for March and what kind of numbers they show for the holiday season. Because if they're not able to show unit growth in China, then this is they're not going to grow more than 5% a year for the next couple of years.
Talk to me about India, because you mentioned that as a growth market. I am surprised that Apple hasn't tackled that market with a lower priced phone to just get a foothold and then trade up as the consumer matures.
Yeah, Paul, from a business case point of view, it always makes sense, but we have to always remember Apple is a company that really cares about gross profit dollars more than it cares about market share. It has been the case for 20 odd years. They're not going to go out with a cheaper, PC product. They're not going to go out with a cheaper phone. But in reality, India, the purchasing power is very low. It's compared to China, it's nothing. I mean, frankly speaking. So iOS market share in India is less than 5% of total units. So when we look at total growth rate, I think it's going to be many years before India becomes a big portion of Apple's growth rate.
All right, let's step away from Apple and let's talk about one of the big market themes of 2023, which is AI. I know you guys at Bloomberg Intelligence, your tech team, have done a lot of work on this. You have a big report out, which I recommend people get a hold of on the Bloomberg terminal. It is, I think, the definitive report on AI. What's your view as it relates to 2024 for AI? How do you think this is going to play out, and how should investors maybe try to get some exposure?
I think the near-term advantage we're going to see is with cloud providers. Companies like Microsoft's Azure product or the cloud infrastructure product, Amazon Web Services, Google Cloud, even Oracle Cloud. I think those companies are the first one. They're going to see the benefit over the next 6 months. And we expect their growth rates to start improving only because if you are not a large company that is not going to buy your AI servers or AI chips in-house, the next best thing for you is to go out and pick up a cloud provider and use those computing power and their storage capacity to build your the next chatbot or the next thing that you're building in-house. So I think the biggest advantage of the near term is going to be on the cloud infrastructure part of it. In the longer term, we expect almost all software companies to come up with new co-pilots that can make life easier for you and me in terms of the everyday work we do, whether that's in sales, whether it's in HR, you name it. I think this is one of the bigger themes or the bigger tech movements that we have seen, I would say, ever since the birth of the internet. But we're going to see a lot more money going into this over the next several years.
Do you think we're going to see, I don't know, when I think about some of the landmark IPOs of, say, the internet, whether it's, Google for search, Yahoo for, an ISP, is there something that we should expect a big AI-related IPO to kind of just really jazz up everybody and become that bellwether?
Yeah, I think it will be companies like OpenAI or Anthropic and companies like that are actually coming up with these large language models that people can use to build up their applications. Now, I have no way of knowing whether OpenAI, given their corporate structure, whether they will go public or not, but it would be companies like that, Hugging Face. There are many more. There are dozens of these companies that are completely startups right now. But I do not know whether they want to remain in the public markets or they want to do this privately till they actually get to a profit structure. Because one of the things we have seen in the software world is its profit is far more sought out right now than growth rates. Now, there may change behavior of the the investor, but at this point, I think it will be a little bit while before we see major IPOs coming in.
Magnificent Seven had a great run in 23. How do you think tech's going to do in 24?
I think it'll be very interesting because from a fundamental point of view, this is going to be a very good year for tech. Now, I don't know about the stock reactions because we have had an amazing year last year, and they have to live up to those expectations. And there was another point I brought up before. You know, this year we are going into an economic cycle where people are not expecting a hard landing. When you don't expect a hard landing, then, you know, typically people, you know, pivot towards smaller stocks or smaller companies that have been left behind over the last several years.
All right, Anurag, thanks so much for joining us. Anurag Rana, Senior Technology Analyst for Bloomberg Intelligence from the hub of Bloomberg Technology Research, Chicago, Illinois. How about that? Looking at the markets here, S&P 500 off about 0.7%. The NASDAQ off about 0.9%. So again, the second day of selling here to start out this year. But again, let's put it in context because context matters. We had just this ripping rally in the stocks really from late October through year end. So giving a little bit back there, a lot of folks will tell you that's healthy. Russell, the Russell 2000, the small cap index off 1.6% today. Again, that had been the outperformer during the fourth quarter of 2023. So a little bit of a pullback there. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
Hey there, Paul. Disney's board battle is intensifying. The company says it's won the support of Value Act Capital Management for its board nominees, and hedge fund Blackwell's Capital is said to be nominating 3 directors at Disney. Bloomberg's Abigail Doolittle has more.
Value Act and Blackwell's essentially saying that they are going to enter the fray on the side of Disney and Bob Iger well ahead of the company's annual meeting that typically occurs in March or April. Now, to set the stage again, Nelson Peltz's hedge fund, Trian Partners, they plan to nominate 2 candidates to Disney's board this year. They have a roughly $3 billion stake.
Disney shares are little changed. And the 3 largest wireless telecommunications networks in the U.S., they're being accused of ripping off 5G technology. Bloomberg's Steve Potisk has that story.
According to 3 lawsuits filed in Texas, AT&T, T-Mobile, and Verizon Communications all refused to license essential technologies covered by 11 patents owned by Pegasus Wireless Innovation, which got those rights from Korean telecom pioneer KT Corp. Pegasus says it's spent a year trying to negotiate a deal with the 3 providers, which have yet to comment on the lawsuits.
AT&T is up about 0.1%. We have Verizon up about 1.5%. T-Mobile up more than 1%. Meanwhile, Elon Musk's SpaceX has launched its first cell service satellites with T-Mobile. Now, the Starlink satellites, they work with users' existing phones rather than using specialized equipment, and they help bring more connectivity to remote areas. They'll enable text messaging first and then later offer voice and data. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
Headlines and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
Coming up to 10:22 on Wall Street, I'm Nathan Hager. Stocks are extending their New Year declines while Treasuries are paring their losses. That's after manufacturing PMIs from the Institute for Supply Management showed factory activity in this country in a 14th straight month of contraction. Check the markets all day long here on Bloomberg. Right now, the S&P 500's down 32 points or 0.7%. The Dow is down 233 points. That's a 0.6% decline. And the tech-heavy NASDAQ composite is down 1% or 150 points. 8 of the 11 main industry groups in the S&P are in the red. Only energy, utilities, and healthcare are showing gains right now. 10-year Treasuries down 16 seconds for a yield close to, well, now it just flipped up to 3.99%. The 2-year is at 4.36%. NYMEX crude up 2.8%, up just about $2 at $72.37 per barrel. COMEX gold is down 1.4% or $29.30 at $2,044.10 per ounce. The euro is at 1.0911 against the dollar. The yen is at 143.44. That's a Bloomberg Business Flash, Paul.
All right, Nathan Hager, thank you so much. Paul Sweeney here. We're live in our Bloomberg Interactive Brokers studio solo today. Why not? We're also streaming live on YouTube, so you can head over to youtube.com and search Bloomberg Radio. Man, it is good to be JP Morgan. I was just looking at the stock. It's at an all-time high. The stock's up 30% over the last 12 months. It's got a market cap of $493 billion. It's good to be Jamie Dimon. Sally Bakewell joins us here in our Bloomberg Interactive Broker studio. She covers all the financial stuff for Bloomberg News. I mean, it's good to be JP Morgan, isn't it, Sally?
It is. I mean, if you think about the last 12 months that we've had, we saw a number of bank collapses, we had continued rising interest rates and still pressure from inflation. Well, JP Morgan had this very, very good year. And in fact, it's on track for its biggest annual profit in history, in the history of American banking. Its earnings for the first 9 months of last year rank as the company's second best ever. It, of course, benefited from the turmoil. It attracted more than 50 billion of depositors who were, of course, nervous by what was going on and were worried about their money. Then it got a very sweet deal to buy First Republic.
Yes.
And that has given it access to a big new client base, and it's also been able to step into the void created by the other collapse of Silicon Valley Bank. So all in all, it's kind of come out winning.
I mean, if I'm a competing bank, I don't know, Bank of America, Citibank, I'm like, wait a minute. This isn't fair. I mean, it's not that it's not fair. It's just like, are they kind of getting the benefit of the doubt here? I mean, but I guess for these banks, they just bid more than others wanted. I mean, there's no sense that they got preferential treatment from the Fed or anything.
So they were able to, with the weight of its $4 trillion balance sheet, it was able to come up with the highest bid. And also it was the bid that would ultimately be the least ugly hit to regulators' deposit insurance fund. So probably from their perspective, you know, JP Morgan's too big to fail slogan and moniker actually became a kind of beacon of stability and a helpful element in winning First Republic.
I mean, and you look at the league tables, they're at or near the top in just about everything. I mean, I can't think of a company-specific reason, like if I were an investor, not to own this thing. I mean, it is American banking for all. In fact, it's almost like the old Rockefeller days with JP Morgan.
Well, indeed, and in fact, he's been likened to Rockefeller. In fact, and James Gorman, who we will shortly be hearing from, he also praised Dimon on TV as the best bank executive in the world. But it's not to say there are no risks here. I mean, Jamie Dimon himself has said that it may be over-earning in some areas. So, you know, while everything does look very positive, there are headwinds, there are risks.
I mean, so it's interesting. If you're Jamie Dimon, I guess one of the issues for JP Morgan that if you're an investor you have to get comfortable with is succession. I mean, Jamie Dimon has such an outsized presence, not just in global banking, but global business. You know, he's a top 5 CEO, I would say, globally. How do you replace that? I mean, and what do you do? That's got to be a tough act. What do we know about Jamie Dimon and the bank and succession?
So Jamie Dimon is currently about halfway through a 5-year period whereby he will receive a reward to stay that he was offered, 2.5 years ago. Despite having moved on 2.5 years, I think we're not really in that much of a clearer position about exactly what happens with succession. Jamie has always joked that he is going to, whenever asked, that he will stay on for another 5 years. But, you know, there are candidates. We sort of know of the Jen Piepzak and Marianne Lake are probably the two, the co-heads of one of its business units that are looking like the likely contenders. But there are others in the mix. But yeah, I think the bank would say that they have a very firm succession plan in place, but I think that is one area where investors, and certainly we, are slightly more in the dark.
I mean, I'm looking at the Bloomberg Terminal estimates his net worth at $2.4 billion. And you talk to investors, I'm sure most of them would say he's worth every penny, that $2.4 billion he's earned for shareholders. Speaking of succession, we have another major Wall Street firm about literally, as we speak, undergoing a succession plan. James Gorman over at Morgan Stanley stepping down. Ted Pick, a senior executive, stepping up and assuming the CEO role. And Shonali Basak, our Wall Street reporter, is going to be sitting down with James Gorman in just a matter of moments, and we'll bring that interview to you. But boy, that's worked out well, I guess.
Yeah, I think it was a kind of template for how succession could go, because, you know, if succession doesn't go well, that can really affect a bank's performance. But James Gorman, he had 3 potential contenders to replace him. Ted Pick, he emerged as a winner, but the other 2 candidates were planned to stay, which is actually a bit of a bloodless coup. And indeed quite rare. And it was a very orderly handover. And Ted Pick, he started on January the 1st.
Yep. So I mean, again, it's a nice, and Mr. Gorman will stay on as chairman, so good little continuity there, and so. If you're a Morgan Stanley shareholder, you got to be pretty happy with that succession plan.
Yeah, I think Pick will be able to lean on Gorman, who has indicated he wants to help with the transition. And while we don't necessarily know how long that will be for, when Gorman was made CEO in 2010, his predecessor John Mack held the role of chairman for about 2 years. So perhaps that's the kind of time frame here. And Pick, he's the man credited with spurring a revival in the bank's trading business after a very perilous stretch during the financial crisis, when clients were ditching Morgan Stanley left and right. So I think he's generally viewed as a very solid pair of hands to take things forward from here.
Yep, looking at Morgan Stanley stock, it's a $150 billion market cap over the last 12 months, up about 11%. So again, looking at Morgan Stanley, seemingly nice succession taking place right there. Sally Bakewell, thank you so much for joining us. Sally Bakewell, she covers all the financials for Bloomberg News. And we're going to bring you in just a couple of moments here. Morgan Stanley outgoing CEO James Gorman's sitting down with Bloomberg's television's Shonali Basak to talk about this transition of senior leadership at the vaunted Morgan Stanley. That's coming up right now. Take a listen.
Welcome to our Bloomberg television and radio audiences. I'm standing by with a very special interview, an exclusive with James Gorman, the executive chairman of Morgan Stanley, recently stepped down from his post as CEO. And this is the first interview in your new role as executive chairman. What's your most urgent priority?
Well, it was obviously to come and do this interview with you is my first priority. It's to support Ted. And he's a terrific guy, will be a great CEO. And my job really is to help him as best as I can, but stay out of the road. So that's really my priority.
It's interesting. I've heard you used to handwrite a checklist of priorities at the start of every year. If you think about how you change gears into executive chairman, what does that checklist this year look like?
I didn't write it this year. I did that when I was CEO for 14 years, and it gave me a framework for focusing on a few big things that matter. Because in these jobs, there are thousands, literally thousands of issues that come at you, and you can easily lose sight of the stuff that actually matters, which is a few big things. So every year, I would tee up on the first day I came into the office, which was yesterday, I came in, and write down the list of 10 things. And, one of them was always no new mistakes, which I defined as things that cost us more than $500 million of capital. Sometimes they were personal, like stay fit or get fit, or sometimes they were about development and leadership with our top team. But no, different job, so different. You've got to switch. So that's what I've done.
I'm glad you brought up mistakes, because to the extent that we learn from life's challenges, I'm curious about your single moment What is the biggest mistake you ever thought you've made at Morgan Stanley? You know, this is an exit interview. It's the chance to look back at the last decade or so.
You know, it might sound immodest. I don't think we made a lot of big mistakes. I mean, if you look at the major things that we did, whether they were the deals, Smith Barney, E-Trade, Eaton Vance, succession, which is critical, navigating through COVID, you know, we got frankly most of the big stuff right. I wish we hadn't sold Van Kampen when we sold it to Marty Flanagan and Invesco. So that was something. I think it took a little too long to get the full team that I wanted in place in the right jobs. But you know, you can't do these jobs and not make mistakes. When I see a mistake, I embrace it. You know, it's like Kipling. You have those travelers of success and failure. You got to embrace them both, because if you're not making mistakes, the chances are you're not doing enough. So I never see a mistake as a negative. I just see it as something you learn from, move forward.
You know, it's interesting. You're standing on top of a mountain now. You've had a tremendous amount of success at Morgan Stanley, but those first couple of years were rocky. Were you ever worried in those first few years you'd be ousted before you can enact a turnaround?
No. You know, I just thought, listen, what I felt back then, we had to act, and we had to act aggressively. And I knew that whatever we chose to do, there would be critics. That didn't bother me one little bit, because we're in trouble as it was. So my job was to do something about it, not listen to the critics of what we can't do, but figure out what we can do. So I was highly confident that we'd make choices, and I thought they'd pay off. I thought the rebalancing of the business model was the right choice. So I just didn't listen to the critics.
It's funny, you kind of got Morgan Stanley at rock bottom, if you will, but a lot of investors think Ted Pick's job is even harder because he is on a high note. What do you think Ted's biggest challenge is going to be?
Oh, I don't think it's harder or easier. They're just different. You go through different cycles. I mean, the Morgan Stanley I've had for the last 5 years is very different from the first 5 or the middle 4. You know, for Ted, he's got one of the biggest and most successful companies in the world. Phenomenal brand. He's a great culture carrier, so I'm sure the culture will stay intact. The real choices will be strategic. So when opportunities come to move left or move right, how do you do that? How aggressively do you do it, and when do you do it? So they're really the choices. And in the first year, while I'm here, I'll obviously share with him whatever, you know, views I have on stuff if he wants that. But in the later years, he'll have his team working with him on that. So I'm confident about that.
We'll talk more about strategy in a second, but another thing, as you transition to executive chairman, you have roles now outside of the bank. And succession is arguably one of the most important things you could do as a manager, and a big new responsibility for you is serving on the board of Disney, ironically, where succession has been one of the biggest issues. How does Disney live past Bob Iger?
Well, firstly, I mean, Bob Iger is a phenomenal executive. I mean, he is iconic for a reason. He's led that company through so many cycles, and really is a gifted leader. So it's a great pleasure to work with him, but it's not for me to judge Disney's future. I haven't joined the board yet. I'm starting, I think, February 4th or February 2nd, I'm sure, early February. I'm looking forward to it. I like dealing with complex situations. The changes going on in that industry are profound, and there are choices to be made. So that, to me, is very interesting. And obviously, given the experience I've had leading succession with our board here, with Dennis Nally, the head of our comp committee, and Tom Gloser, the lead director, you know, hopefully I can add something to the succession committee that I'll be joining.
What about pressing challenges outside of succession at Disney? Do you think that there's anything that could be immediately addressed as they contend with activists?
Well, you know, and they're always, we've had, how many activists did we have here? We had at least 2, and I think they each had 2 bites at the apple. So no, that is not what the focus should be on. The focus should be on strategic choices companies make. But again, I haven't joined the board, so I can't talk about a company I'm not even an insider on. That wouldn't be fair to the team.
More on strategic decisions at Morgan Stanley. One massive question. You've built this massive wealth management business, mostly in the United States. You have talked previously about the idea of Morgan Stanley internationally expanding more. Do you think Morgan Stanley, though, can be a giant international wealth manager?
Oh, sure. There are a lot of wealthy people in this world. I think population just tipped 8 billion. And, you know, I've just come back from a long trip through Asia, through Thailand, Singapore, Hong Kong. And I was in Europe last week. I've been all over. There are plenty of pockets of opportunity. So it's a question of where you pick your shots. I mean, where you pick your spots. There are endless opportunities. And I think our Asia business, we have a wealth business in Asia. It's small-ish, but growing very fast. Obviously, that's a focus. Japan, I think, with our partner MUFG, is a tremendous focus that I suspect Ted and the team will do even more with, which he's already started doing on the trading side. So there are endless opportunities. I'm not worried about that.
What are the biggest challenges with China in particular, given the rising geopolitical tensions and the state of the economy there?
Well, China has some fundamental challenges. First and foremost is demographics. The one-child policy guaranteed the population is going to shrink. And right when you need more productive working people coming through to support the older generation, they've got fewer of them and they don't have good immigration. So I think China has some profound challenges on demographics. It has profound challenges in terms of building a consumption economy. There's still an export savings-driven economy. So, but on the other hand, China's 1.4 billion people, second largest economy in the world in gross domestic product. It's a key factor in global economic health.
So beyond Asia expansion, if you think about the wealth management space, even in the US, there's another thing that's happening that a lot of financial advisors are thinking about in particular, and that is the approval actually, or the lack thereof, of a Bitcoin spot ETF in the United States. When you think about what wealthy clients invest in, when you think about the future of wealth management, do you think Bitcoin is a suitable investment?
I've never been, I've never really understood the value of Bitcoin as a form of stored value. Others have, and others have made a lot of money on it. I joked once, I wish I bought it at $60, and I'm glad I didn't buy it at $60,000. It's clearly speculative. I think it should play for wealthy people a very small role in their financial fabric because it's so speculative, it's so volatile, and again, it's going through enormous regulatory change and industry disruption, as we've seen with some classic failures of late. So, listen, Bitcoin's not going away. It's not a fad. I just don't think it's a core investment. I think it's a speculative asset of which there are plenty of choices.
Speaking of regulation, you've been very vocal about the new regulations being made in the United States about bank capital, about operational risk. Do you believe the rules are likely to change before implementation based on your recent discussions with regulators? And what do you think they will look like at the end?
Oh, they'll definitely change. I mean, they put out an extended comment period, which got extended further. There have been thousands of comments put into the various regulatory bodies led by the Fed. It was a proposal that I would say was extremely aggressive and set a marker. It will not go through in that form. If it did, I think it would have very, very negative consequences for corporate lending across this country, which is not what you want. It's not going to help the economy grow.
Well, you've also spoken about the Treasury market potential impacts from these regulations. We've already seen stresses of late in the Treasury market. Do you have fears that those stresses will be exacerbated?
I can't tell until I see the actual rules, but all I know is what was put out is highly, highly, highly unlikely to be what is ultimately regulated. Now, investors don't necessarily see that or agree with it, but in my experience, I've been doing this a long time. I was on the Fed board for 6 years in New York. I chaired the FAC in Washington. I think this is a highly aggressive proposal that will be materially wound back when it finally becomes law or regulation.
Now, there has been tighter capital rules proposed under the Biden administration. There's also been a lot of regulatory actions taken against banks. If the Republicans take the White House in 2024, whether it's Donald Trump or another contender, do you expect that this tighter regulatory environment will just fully unwind?
It's too hard to predict. I think we're in, you see pendulum swing, and we swung to lighter regulation to, I think, an excessive proposal. I think it'll swing back. So it's heading back to more balanced regulation. And that's where it should be. I'm all about balance. The banking system should not be deregulated. That would be a nightmare. On the other hand, if you over-regulate and you require capital standards that are so high that the banks are uninvestable, they can't grow. That doesn't serve communities well. You need prosperous, thriving banks to provide lending products for small businesses and consumers.
You know, to the extent we're less than a year away from a spate of bank failures, to the extent that there are still fragilities in the financial system, what are they?
I don't think there are a spate of failures, honestly. I think there were 3 banks that got it wrong. I've said that publicly. They made choices that were the wrong choices. Wasn't complicated. They got washed up and cleaned up and folded into other banks, and you move on. This wasn't, people kept telling me we're having a banking crisis. I said, no, we're not. We had a crisis among 3 banks. It was a crisis for their shareholders and their employees. It's not a crisis for the market. The core banking system is in rude good health, to use a British expression.
Well, you know, it's not just the banking system. If you think about the hedge fund industry, regulators are also very concerned about some fragilities there. It wasn't too long ago that Morgan Stanley lost almost $1 billion in the wake of the collapse of Archegos. Do you think that there needs to be more safeguards on the non-bank system?
I mean, honestly, there's too many participants in the non-bank system to say yes or no. You'd have to go subset by subset. Are we talking about payments? Are we talking about private credit? Are we go through each of the pieces of it. But there are always risks when you're dealing with leverage in a financial system. But if you don't have leverage, you don't have lending. So it's a balance. Again, I'm always back to there is a balanced solution to most of these debates, and you can find it with thoughtful discussion with regulators.
Speaking of leverage, the cost of leverage is higher today than it was a couple of years ago. Where do you think interest rates go headed into the end of the year? And what do you think the market starts to look like through 2024?
They go down.
As simple as that?
Yeah.
How far down?
I've got no idea. I mean, I thought that unlikely the Fed would cut rates this year, but inflation has moved down pretty materially quickly, that it's now become more likely. So first half of the year, I suspect nothing. Back half of the year, they could easily move a couple of times. But the key point is, we started this journey with inflation at 10%, rates at 0, unemployment at 3.5%. And my objective was to get us to 4, 4, and 4. 4% inflation, 4% rates, 4% unemployment. We're about 3% inflation, we're 5%, 5.5% in rates, and we're about 3.5% in unemployment. So rates will come down.
Do you think the economy's in an all clear when it looks like a soft landing versus a hard landing? Do you think that the economy will survive this year in good shape?
The economy's fine. I mean, there's this obsession with the R word, recession. I mean, you have recessions. They come and go when you get imbalances between unemployment rates and economic growth. So, no, the economy is doing fine. I personally think it is unlikely we'll have a recession. Very unlikely we'll have a hard landing. But we'll see. But the odds are clearly in favor of a soft landing. I think the Fed's done a great job.
Now, for you, you've told me before that you would look to teach in your post-life at Morgan Stanley and your life after Morgan Stanley. I want to ask you about that for a moment, because there is a lot of turmoil on college campuses these days. Do you think you'd ever take a bigger role at a university, given all the political pressures and donor activism that you're seeing?
Well, I'm joining, I have been the chair of Columbia Business School for many years, several with Henry Kravis as my co-chair, and now chair of the school. I'm looking to get more involved at Columbia University in the coming months, and I think that'd be great to do. I think the importance of high-quality education for a well-functioning society is profound. It's obvious. So yeah, I want to be part of that. And obviously, universities. This is not the first time universities have been hotbeds of dissent and turmoil. My whole life they've been that, from when I went to university in Australia in the 1970s. So that doesn't bother me. But it's important that people are able to have dialogue and discussion on campus without intimidation and expressing their rights for free speech.
What is the next big ambition for James Gorman?
You mean today, or? No, internally Morgan Stanley is to help TED and to help with our clients around the world. I have a very large client network that I've built up over a long career, and I think I can help our bankers and others in that regard. For me personally, it's to live in a little bit of a world of unknown. For my whole life, I've kind of known what the next steps are. As you mentioned, I've joined one public company. We'll be joining one public company board, Disney. I'll be getting more involved at Columbia University the months ahead, and then I'll take it from there. So I want balance in my life. I've loved being CEO. It's a phenomenal company. I'm so proud of my colleagues here. The job that they've done. This isn't a one-person show. It's thousands of people who are really talented doing the right thing. And ultimately, it's the values of the organization, which is what drives it. So that's what I'm most proud of. And for me personally, we'll find out.
Well, James, thank you for your time, your first interview in your new role. That's James Gorman, Executive Chairman now of Morgan Stanley for Bloomberg Television and Radio.
All right, that was Bloomberg's Shanali Basak sitting down with Morgan Stanley's Executive Chairman now, James Gorman, talking about life after the CEO seat for Mr. James Gorman. What a run it was for him as well. Quick data check here. We're looking at the S&P 500 off about 0.8%. Same for the Dow. The NASDAQ off a little bit more, about 1%. The Russell 2000, that had been kind of the outperformer in the fourth quarter of last year. That's off 1.9%. So a little bit of profit taking there in the equity markets. Day 2 of 2024 trading. Looking at the yields up just slightly, about 6 basis points on your 10-year. That's at 3.99%. WTI crude oil, it's up 3% today, $72.50. And Bitcoin, got to call that out for Tom Keene, it is off 6% today. A little bit of profit taking there, 42,375 for Bitcoin. Let's talk a little bit of economics here. We're going to get some Fed minutes today, and I want to get a sense of kind of where we're going here with economic policy. Michael McKee joins us here in our Bloomberg Interactive Broker studio. He covers all things economics for us. Michael, we're going to get some Fed minutes later today, 2 p.m. Wall Street time. Anything juicy in there, or is this going to be hopefully pretty mundane?
We always look for the juice, but unfortunately, most of it gets squeezed dry by the Fed officials who speak between the time of the meeting and the time the minutes come out. The thing that Wall Street wants to know is if you're going to cut rates, is it really going to be 3 times or is it going to be 6 times like we want? And when are you going to start? And probably that's not going to be in the document, in the minutes. There may be some characterization of what the economy might need to be like before they begin considering rate cuts. And so that would be of great interest to Wall Street. But we've basically heard from most of the people on the Open Market Committee between December 13th and now, and they tend to all kind of say, well, if things develop as we expect, then we could consider cutting interest rates, not giving anybody any definitive answers.
Right. So we had some ISM numbers today. ISM manufacturing still in contraction mode, but a little bit better.
A little bit better. And Tim Fiore from the Institute for Supply Management says it's basically 2 things. 2 points he made. One is that this survey was largely taken before the Fed's December 13th meeting. And so it doesn't reflect what business people think will happen if rates are cut, which he characterized as good things. And then he also noted that we're a little bit better, and we're seeing basically we're in the trough, and it would be going up from here.
Interesting. And Michael, just about 30 seconds left. I guess non-farm payrolls Friday, still looking for positive 171,000 jobs.
Yeah, that's interesting. Everybody's been expecting the job market to cool. JOLTS today came in with a few less job openings, but not a significant drop. So we could still see a fairly strong labor market, and unemployment's only expected to go up by 1/10 to 3.8%. So the Fed's story continues, is the way I put it. When the numbers came out, it just continues the narrative that Morgan Stanley's James Gorman just gave us. Said the Fed's done a good job, recession's unlikely, and the economy is fine.
The economy's doing fine, as per James Gorman, and he has a good perch, that's for sure. Michael McKee, thanks so much for joining us here. Michael McKee sporting the very sharp sweater there today, little cash look on top of the shirt and tie. That's a good look for Michael McKee. I can't pull that off, but certain people can. S&P 500 off 0.8%. This is Bloomberg. Let's get some company news right now with Lisa Mateo.
You could pull that off, Paul. I know you could. Good morning to you. Apple, it lost more than $107 billion in market value yesterday after analysts at Barclays downgraded the stock. Dan Ives, who covers Apple at Wedbush Securities, says this is going to be viewed as more of a golden buying opportunity.
The next 3 to 4 quarters, you're going to have iPhone growth. You have growth coming out of China, despite the fears and obviously a lot of the bear noise. And I think the most important thing is services. I mean, I think services is going to be teenager type of growth. That's key to the multiple expansion story. And then we go into later this year, there's just going to be more monetization from an AI, as we talked about. That's going to be the next layer.
Apple shares down more than 1%. Turning to crypto, Coinbase is leading the sector lower on speculation of the spot Bitcoin ETF approval. We get more from Bloomberg's Katie Greifeld.
The SEC has a deadline coming up next week to take action on one of the dozen or so applications in their queue right now. And the current thinking is that they'll either approve or reject all the applicants at once rather than playing kingmaker here. So as you would expect, rumor, innuendo, it's at an all-time high right now. That's translating into volatility, both in Bitcoin itself and those crypto-related stocks. But it's important to note that all of these assets, all of these names, they're coming off a banner 2023.
Coinbase down nearly 4%. And after announcing that it was in early talks to sell its data and cybersecurity business to Airbus, shares of Atos are falling. They're down right now. They're down about 5.5%. Now, analysts say the $2 billion offer is low and the outcome uncertain, as a French tech firm is looking into different restructuring options. Those are the company stories we're following this hour. I'm Lisa Mateo. This is Bloomberg.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, taking a look at these markets, a little bit of sell-off today following on yesterday's sell-off. So for the second day, we are in the red here. The S&P off about 0.75%. The NASDAQ off about 0.9%. And the small cap Russell 2000 off 1.8%. Yields a little bit higher here. 10-year Treasury up 5 basis points, 3.98% on your 10-year. WTI crude oil up 3%, just about $72.70 per barrel. Bitcoin, it is trading off here 5%, 42,900 on Bitcoin here on that sell-off. Had a big run-up and ahead of a potential ETF ruling that we expect any day now. Right now, let's head down to Washington, D.C. We'll get world and national news with Amy Mars.
All right, thank you, Paul. President Biden is pivoting to focus on getting reelected. With a speech on the anniversary of January 6th, he'll take aim at Donald Trump during that speech near Valley Forge, where he'll mark the anniversary of the assault on the U.S. Capitol. Biden will also deliver a similar message on Monday in South Carolina. That's the home state of Nikki Haley, where he will speak at the historic Black church in Charleston, where a white supremacist killed 9 people in 2015. Migrants sent mostly from Texas arrived at train stops outside New York City over the weekend, sidestepping a new order limiting how they arrive. Hundreds of migrants took a detour in New Jersey, bypassing a city order limiting the number of arrivals. New York City and Chicago recently began restricting migrant bus arrivals, and now the crackdown is spreading to the suburbs. Hinesdale Village President Tom Cawley spoke at a board meeting.
We've recently been advised by a bus driver that unless we do something, these buses will keep coming, unannounced, at least through March.
4 Chicago suburbs, including Hinesdale, are taking official action, passing ordinances to fine bus companies that drop off migrants without notice. Former President Trump's legal team is appealing a decision from Maine's Secretary of State banning Trump from appearing on the primary ballot. Shenna Bellows says Trump's actions on January 6th would make him ineligible to run for office.
The qualifications for president under the United States Constitution are not a menu. They're not optional. My job is to follow the Constitution and the law.
Trump's legal team claims Bellows overstepped her authority. Former UN Ambassador Nikki Haley's campaign says she raised $24 million in the final 3 months of 2023, riding a wave of momentum in her bid for the Republican presidential nomination. And that's more than double what she raised in the third quarter. Haley and Florida Governor Ron DeSantis are jostling for second place behind former President Donald Trump as voting gets underway on January 15th with the first in the nation Iowa Republican caucuses. And a winter storm is slated to bring snow, rain, and wind to the east this weekend. Forecasters aren't sure yet how much snow the system can be expected to bring, especially for areas near the I-95 corridor. Bloomberg meteorologist Rob Carolyn tells us we'll know more tomorrow, so we're going to keep tabs on that. If this does materialize, it would be the first snow in 2 years for D.C., Baltimore, Philadelphia, and New York in 2 years. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Amy Morris, and this is Bloomberg. Paul.
All right, Amy Morris, thank you so much. We appreciate it. Coming up in the show, we're going to check in with Geetha Ranganathan. She is the media analyst for Bloomberg Intelligence. I want to ask her what's going on with our good friends at the Walt Disney Company. Some reporting coming out today from Bloomberg. Walt Disney Chief Executive Officer Bob Iger is lining up allies as he seeks to stave off pressure from billionaire activist Nelson Peltz. Value Act Capital Management pledged on Wednesday to support Disney Board's nominees at this year's annual shareholder meeting and will consult with it on strategy as the world's largest entertainment company works to improve its financial performance. At the same time, activist hedge fund Blackwell's Capital, which back Iger's efforts, is nominating 3 directors at Disney who would champion his CEO strategy and offer an alternative to Peltz's Trion Fund management. Support from Value Act and Blackwell's gives Iger a significant public relations victory and puts additional pressure on Trion to better articulate an alternate vision for the company's future. Looking at the shares of the Walt Disney Company today, looking at Disney, DIS is the ticker, off about 0.4%, and over the trailing 12 months, pretty much unchanged, only up about 1.9%, dramatically underperforming the market here. So the issue for some of these activist investors are saying here, hey, the stock is underperforming. There's a lot of valuable assets there at the Walt Disney Company. Maybe a change is needed. And Bob Iger says, I have a plan. Give me time. We'll pay attention to that. This is Bloomberg. Liz McCormick in studio.
This is Bloomberg Markets with Paul Sweeney and Matt Miller.
Why were the economists so wrong? What are the economists getting wrong?
Isn't this a slam dunk time to buy U.S. Treasuries? Soft landing, hard landing, no landing? I don't know. True, what the heck does that mean?
I don't know.
Breaking market news and insight from Bloomberg experts.
We're going to be in an environment with higher rates for longer.
The 5-day in-office work week is effectively dead.
It's definitely a good sign that we're not ready to land this economy just yet.
This is Bloomberg Markets with Paul Sweeney and Matt Miller on Bloomberg Radio.
All right, coming up in this hour, we're going to check in with the Liz McCormick, chief correspondent of macro markets for Bloomberg News. Get her thoughts on the fixed income market here for 2024 after a strong 2023. She's going to join us here in studio. Also in studio, Janet Lauren, higher education reporter with Bloomberg News. We're going to discuss Harvard University President Claudine Gay stepping down. What's next for Harvard? What's next for higher education in general as they deal with some difficult challenges? So that's all coming up in this hour. So that'll be some good stuff. But first, let's head down to Washington, D.C. We'll get a Bloomberg Business Flash with Nathan Hager.
Day two of trading in 2024, Paul. It's day two of losses for stocks and bonds. Today, it's after a 14th straight month of factory contraction, according to the Institute for Supply Management's manufacturing PMI. We also saw JOLTS job openings data come in slightly weaker than expected for the month of November. Investors will be looking for more clues on the path for interest rates when the Federal Reserve releases minutes from its December meeting today at 2 p.m. Wall Street time. In his first interview as the former CEO of Morgan Stanley, we asked James Gorman where he thinks rates are going. His short answer, down. Here's his long answer about the economic outlook.
We started this journey with inflation at 10%, rates at 0, unemployment at 3.5%. And my objective was to get us to 4, 4, and 4. 4% inflation, 4% rates, 4% unemployment. We're about 3% inflation, we're 5%, 5.5% in rates, and we're about 3.5% in unemployment. So rates will come down.
Morgan Stanley Executive Chairman James Gorman speaking there moments ago with Bloomberg's Sonali Basak right here on Bloomberg Markets. As for the market, we check it all day long here on Bloomberg, and the S&P 500 right now is down 27 points or 0.6%. 47.15 is the S&P level. The